campaign brought in. Though the Harris campaign also far outspent Trump in August, the vice president ended the month with $404 million in cash on hand, dwarfing Trump's $295 million war chest. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes. Up next on the program, competing visions for the U.S. economy.
I had the greatest economy in the history of our country. I think in the history of the world. There's never been such production that we had, and I'll be able to do it again, and I think very quickly.
Jason Furman, up next.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Live from New York City, your equity market a little bit firmer, up 0.1% on the S&P 500. In the bond market, things pretty stable. Yields are higher by almost a basis point, the 10-year 374.89. Under surveillance this morning, competing visions for the U.S. economy.
I had the greatest economy in the history of our country. I think in the history of the world. There's never been such production that we had, and I'll be able to do it again, and I think very quickly. We were energy independent just a short while ago. We'll be energy independent, but we'll actually be energy dominant again. And we're going to make a lot of money. We're going to pay off debt. We're going to pay down debt. And we're going to do things that nobody would have thought possible.
So here's the latest. Donald Trump and Kamala Harris planning dueling economic addresses. Trump speaking at Georgia tomorrow, offering his plan to lower taxes for business owners. And Harris saying she'll deliver a speech this week outlining her economic vision. We get lucky this morning. We're joined by Jason Furman, the professor at the Harvard Kennedy School and former chair of the Council of Economic Advisors under President Barack Obama. Jason, welcome back to the program, sir. It's been far too long. Before we get to the election race, let's just talk about the state of the economy. There's a lot of people still talking about whether we can achieve a soft landing. Do you think it has been achieved already?
I think we're close, but the next core PCE reading on a 12-month basis is going to be probably 2.7%. So inflation isn't all the way there, but labor markets are loose enough. I think inflation is coming down, but there's still narrow perils on either side of reinflation and recession, but a broad path to a soft landing in between those.
Politics, one of the big risks, at least according to Artie Ardeni, who is just on with us. You wrote this terrific op-ed in the Wall Street Journal, terrific writing. I want to start with just the lead sentence. The first modern presidential race between two candidates with undergraduate degrees in economics hasn't thrilled economists. Why not, Jason?
You know, campaigns are never the place where you're going to completely thrill economists. But, you know, I think an awful lot is the voters want to hear incredibly simple solutions to things. You know, price gouging, stop Japanese investment in U.S. steel mills, whole new areas that aren't taxed like tips. And, none of these are ones that any economist would recommend. But, there's just quite a lot of pandering out there.
Well, but at this point, some people would say we always get this to some degree, right? I mean, we get pandering, we get promises that don't get fulfilled. You've been in the political sphere before. How different is this time?
It feels a bit different. Look, there's, by the way, things I like in these campaigns, too, especially an awful lot I like in the Harris campaign. So I don't want to say it's all negative. It feels like more because there's more things around limiting trade and controlling prices, a certain type of government intervention, as opposed to the standard, promising lots of tax cuts or spending increases is more the normal thing. This feels to me, more interventionist, more getting in the way of markets, right after they've actually been really quite successful.
And Jason, aren't they both doing this? I mean, Kamala Harris is talking about price gouging on the federal level, and then you have Donald Trump over the weekend talking about capping credit card interest rates. Aren't these both proposals price controls in the U.S. economy?
Yeah, I mean, Donald Trump doesn't seem to be the type of person that respects free markets, competition, and all the things that go into it. He believes very much in a strong government. When he was president the first time, he tried to direct investment this way and that. So yeah, I don't think he's a particularly free market guy.
Can you give us a sense of how you view, if Donald Trump's not a free market guy, who is Kamala Harris?
I'm looking forward to that speech this week. I think we'll hear more about how she defines herself economically. To a first approximation, you can expect a continuation of the types of policies we saw in the Biden administration. But remember, a very, very different context. I thought the initial stimulus was too large, but that's not going to repeat itself. We're not going to have, hopefully, knock on wood, another massive global pandemic that will create the conditions for something like that. So, there have been some whispers about being more pro-business. She spent more time with CEOs than President Biden did. Pro-business has its pros and cons, but on balance, I think wouldn't be a bad direction to move just a little bit in the way of right now.
How different would we see a Kamala Harris as a president if we get a sweep versus gridlock in Washington?
I'm not sure about the whole theory that gridlock is the most fiscally responsible outcome here. With gridlock, you're going to be able to extend an awful lot of the tax cuts. It's going to make it hard to enact deficit reduction. And in the past, you've seen the parties make deals where one party gets extra defense spending in exchange for the other getting non-defense spending. So the whole gridlock is good for the deficit thesis. I'm really not sure I believe. If you had a certain number of Democrats there, there's taxes you could raise that you couldn't raise in divided government, and that might result in a lower deficit than you'd otherwise have.
Jason, I want to finish where we began. You began by saying that economists don't like the kind of tariffs that either side are proposing, the kind of limits to trade that we're seeing proposed. And yet we've seen increasing threats to the supply chain. We've seen increasing questions about, national security issues raised by certain fissures, the breakdowns that we've seen. If we do get some of these gates, some of these tariffs, which both sides are proposing, does that increase the risk of inflation or reignition of inflation in a really material way next year?
Yeah, look, on tariffs, there's a massive difference between these two candidates. Donald Trump is calling for 10 to 20% tariffs on everything coming into the United States. That's stuff that we're just not going to be making here, like ballpoint pens. That's stuff coming from countries that are close allies, like Australia. There's just no coherent theory around that, and it's just at a scale that dwarfs anything that you've seen done in the Biden administration, or I think plausibly would be done in the Harris administration. So absolutely, you follow through on the Trump tariffs, you're going to get a burst of inflation and a real quandary for the Fed, because it'll both lower economic growth and raise inflation at the same time.
Jason, we've got to leave it there. We'll continue that conversation on the Fed and the prospect maybe of rethinking rate cuts with rate hikes in 2025, if that is the direction of travel. Jason Furman there at the Harvard Kennedy School on the latest. Should we talk about tariffs?
Yeah.
I remember hearing exactly the same thing about the Trump tariffs going into the 2016 election. 2017, 2018, exactly the same criticism, and they kept them. So I've got no idea if it's going to be too different this time around. I understand it's a very different policy, but will they keep them if Trump gets another term and does exactly what he says he's going to do?
Well, both of these individuals like the idea of tariffs. It just feels like Trump likes them even more. He's the self-proclaimed tariff man. My question is this a blanket day one, 10% ring around the United States, 60% when it comes to China, or is it what Scott Besson told us, which is 2.5% on China for 24 months? Xi Jinping, tell us when it starts to hurt. Is this a negotiating tactic, or is it going to be full throttle tariffs within 24 hours of getting the White House?
As for the deficit, I think at this point it's just what is the least worst outcome for the deficit, because there is seemingly no appetite to dealing with it at all.
We have some auctions this week. $69 billion of 2-year notes tomorrow, $70 billion of 5-year notes on Wednesday, and $44 billion of 7-year notes on Thursday.
Looking forward to that. We'll get the results and a traffic update from Lisa throughout the week. From New York City, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This just published in the last 24 hours from Stuart Kaiser over at Citi. The September event obstacle course did not offer true clarity on growth, the election, or Fed policy. As a result, event risk gets rolled forward another month with payrolls the belle of the ball. payrolls 2 Fridays away. Equity futures on the S&P 500 right now up by 0.1%. On the Nasdaq, up by a little more than that. On the Russell, up by 1/3. In the bond market, the 2-year up by not even a basis point through last week. 357.61 going into a sprinkle of data, a ton of Fed speak. And a few auctions this week too.
Yeah, I'm watching the auctions, of course. I don't know how many other people are. I'm curious about the 7-year note in particular, at a time where we don't really have a sense of what the bigger risk is. The idea of whether we do get some sort of market deterioration in the economy or whether we get a sort of leveling out inflation right here. I will say, a big question for this market, are stocks less interest rate sensitive than they have been in the past? In other words, are bonds moving to their own tune, to their own music, rather than stocks?
Well, the long end is moving to a different tune than the front end. The 10-year right now, I think, is advancing for a 5th consecutive day of yields climbing on a 10-year yield. The 2-year, 10-year, the difference between the two, the most positive going back to early June 2022. That curve steepening continues this morning.
And I guess is that good or bad, right? And a lot of people will say that typically when it disinverts after a period of inversion, that typically signals recession. This time around, people are saying this time is different, and then they huddle in a closet feeling anxious because you never want to say those words.
In a closet with tin hats. Looking at Europe, disinversion at the German yield curve.
That was good.
Thanks. 2-year still rallying, euro weaker, euro dollar 111.22. The single currency getting beat up a little bit, recovering somewhat following weaker than expected PMI data across the continent.
This is what it looks like. The euro area's September manufacturing PMI fell to 44.8 versus 45.8. The September manufacturing data in Germany to about 40. Just this is full contractionary kind of levels that go to the lowest since we've seen going back to the end of last year. How does the ECB continue to hold the line that they're not going to cut more steeply than the Federal Reserve facing an economic environment like that?
Euro dollar 111.21. We're down 0.4% on that currency pair. Under surveillance this morning, Israel stepping up airstrikes against Hezbollah in southern Lebanon. IDF forces striking multiple targets as civilians are urged to move out of the area.
Well, John, when it comes to this, Lisa, I think, hit the nail on the head earlier. This feels like it is already an all-out war, just not in name only. Over the weekend, Admiral Kirby was talking about how they are telling the Israelis there are, quote, better ways to ensure Israeli citizens could return to evacuate homes in the north than a war, than an escalation, than opening up a second front. But that escalation is already at their doorstep.
I mean, look, they're already lobbing missiles. I think there was something like 8,800 missiles that Hezbollah has already launched at Israel since October 8th. You have ongoing strikes by Israel on Hezbollah, not to mention the walkie-talkies and the beepers and some of the other explosions that we've seen. Question here is, what does escalation look like? I think we're not asking the right question by saying, will there be escalation? It's how far will it go?
We keep asking, when does the war start? I think you said it a little bit earlier. What else do you call this?
Yeah.
Right now?
I mean, this tit for tat, we're seeing buildings exploding. Honestly, at a certain point, I think the bigger question is this the modern warfare? How much are people taking some cues from supply chain disruptions, from certain types of strategic blowing up of arsenals? There are lots of things that people are looking at. This is modern warfare, but this is very much a war.
Well, this is prospect of another war in the Middle East. Let's talk about a real war taking place right now. Ukrainian President Volodymyr Zelensky kicking off his week-long U.S. visit in Pennsylvania, stopping at an ammunition plant. Zelensky set to address the UN General Assembly Wednesday and will also meet with Biden, Harris, and Trump this week.
Well, he can't afford to play favorites, can he? Which is why he's going to be meeting with individuals on both sides of the aisle, especially when it comes to former President Donald Trump. I sat down with Zelensky over the summer, and it was very clear to me he really wanted to get in a room with the former president, who was saying that he has a plan for Ukraine. If you have a plan, we want to see it. Zelensky is coming to America with this victory plan that he's going to show both sides. What struck me is the first stop, Pennsylvania. 160,000 Ukrainians live in Pennsylvania. It's the biggest population in the United States outside for Ukrainians. It's also the swingiest of the swing states.
Can we just talk about the use of long-range missiles? How controversial would it be for that to be approved ahead of an election that could change the course of all of this in November?
Potentially it's controversial. The United States has been dragging its feet for it. Biden a number of times has said we cannot allow Ukraine to be able to have the ability to hit, say, something as far as the Kremlin. But the Ukrainians will come back to me and say, we're not trying to hit the Kremlin. What we're trying to hit are Russian bases with jets that they're about to launch at Ukraine and hit strikes like they recently did in the summer that Children's Hospital in Kyiv. So this is a big debate, and potentially we'll get more clarity after the UN General Assembly.
Yeah, one to watch this week, that's for sure. I want to squeeze in this story. Bloomberg learning that Apollo Global Management is offering to make a multi-billion-dollar investment in Intel. This coming days after sources said Qualcomm is floating a friendly takeover of the chip maker. Intel up this morning, Lisa, by close to 4%.
And a lot of sort of post-mortems on how Intel lost the mantle as the darling of the U.S. government and of U.S. hopes to create a foundry that could potentially rival TSMC or at least provide some sort of offset. We really have been talking a lot about whether regulators are going to be more amenable to this, to create a sort of just offset in terms of a chip supplier in the United States domestically, and whether that actually they prefer a Qualcomm takeover, even though they rejected the Broadcom tie-up, or whether they prefer an Apollo investment. Either way, seems like there are investments to be had.
At this point, you've just got to prefer success, right? I don't think Taiwan's worried about TSMC having too much power, are they? I think we just need success in the United States of America.
Especially given the concerns around some of the strategic challenges that should arise if there is conflagration in certain areas.
Good point. Vijay Rakesh, Mizuho, 8:15 Eastern Time. Look out for that. The latest in the banking world, some news for you. At a time when many people are doing their banking online, Bank of America is announcing plans to open more than 165 financial centers across 63 markets by the end of 2026. I'm pleased to say that joining us now is Aaron Levine, the co-head of Bank of America Consumer Banking. Aaron, welcome to the program, sir. I know this is an effort that started about a decade ago. Can we just start there? Just step back and think about the last 10 years or so. How does this move by you and the team align with the evolution of client behavior over the last decade?
Yeah, well, first, thank you for having me on. It's great to be here. Well, you're right. About 10 years ago, we started to expand, and I think the key to think about is what is a financial center used for now as opposed to maybe historically. Historically, financial centers or banking centers were always used for transactions, depositing checks, moving money, paying bills. All of those types of transactional elements have moved onto digital platforms, onto even using ATMs. So what we said 10 years ago is the key for us is how do we provide advice and guidance? How does a financial center become a place where clients come to talk about their life priorities, to talk about what's important, their financial goals? And we have 26,000 professionals, banking professionals, financial advisors, lending specialists, small business bankers, sitting in our financial centers working with the clients. So what is happening is the reason why we keep expanding and growing our financial center footprint is because it's moved from a transactional type of a model to a relationship model, and it's been incredibly successful for us over these last 10 years.
Aaron, you've told me a decade, 2 decades ago that eventually in 2024, 95% of client interactions taking place were on the digital platform. I would have assumed that your physical footprint would be getting smaller. Are you saying it's just going to get different? It's just going to change, and ultimately it won't reduce?
Well, great point. Well, the fact is it has reduced. So, right, with those transactions moving to digital, we have reduced our footprint. If you go back to 2010, we had 6,100 financial centers around the country. Now we have about 3,800. So pretty big reduction. But at the same time, it has completely transformed. So we had now 10 million appointments were made this year alone for people to come in and talk about advice and guidance. So the idea now is financial centers have, for us at least, have hit kind of that equilibrium where there's opportunity for expansion. We certainly keep optimizing the footprint in any given market, but it's the whole purpose of why people come in now is very different. They're coming in, they open up accounts, but they're really talking about how to make their financial lives better versus how to do a transaction. And that's the real shift that we led about starting 10 years ago.
Financial therapy. It's sort of this question about online. There were a lot of things about, you could plan things online in terms of asset allocation, but it seems like it needs to be done in person. Is that right?
Yeah, well, there's a couple things that our clients still like to do in person. 80% of all new checking accounts is opened in a financial center. And what's funny is if you talk to students around the country, and we have a big practice of working with college students and even high school students, many of them will say, I might not even visit the center, but I really want to know it's there. I want to know if I have an issue, there is someone to go talk to in person. So that's a really important component. But to your point is, what really people are coming in for is saying, I've got all these different priorities. I want to save for retirement. I'm thinking about how do I save for healthcare? How do I save for my child's education? And those are the kinds of questions they want to talk to someone in person as opposed to necessarily doing the research that they can do online.
How much is this really direct competition with some of the local banks, especially given some of the meltdown that we saw in the regional banks?
Yeah, I mean, we've had this strategy, again, and a real belief for over a decade on this idea of high-tech, high-touch. So we made major investments in the digital space, things like Erica, things like Zelle, Merrill Edge, our online brokerage platform, all of these big digital investments. But simultaneously, we've always felt that it was critical to keep the in-person component and to transform the centers into a place for advice and guidance. So it's been our strategy. We've been executing the strategy. You've seen our growth over the last 10 years as a result. And most importantly, it's about client experience. You know, we have driven our clients' experience scores to all-time record highs, and that's what this is all about. It's giving our clients a great experience.
When it comes to client experience, how much do clients enjoy the robo-advisors that I know you've done a lot of work with?
Yeah, well, we're really proud. As part of our Merrill Edge platform, you know, we have a self-directed platform, and we built a digital advice model, and it's been a really fast-growing component of our business. You know, what's great is we have the ability for someone to still talk to what we call a financial solution advisor who sits in a financial center, but use the technology to identify their risk and sort of time frame, think about how they want to invest across a set of diverse portfolios, all of which that are created by our Chief Investment Office. So it's lower cost, it leverages digital, but it also has the in-person component, and it's been one of the fastest growing components of our business for the last 5 years.
Aaron, do you have a breakdown of what interaction looks like across income cohorts, across age groups as well?
Yeah, sorry, interactions. Yeah, I think what's great about the Merrill Edge platform is it's really made available for anyone at any income level. You know, minimum to start in a Merrill guided account is $1,000. We have investment clients who are really the entire gamut, from someone who's just starting to invest and try to save a little bit of money for maybe their education, all the way up to people with hundreds of millions of dollars that are using our self-directed platform. We also have very close relationships with Merrill Lynch and the private bank. So for those clients who may use some of their portfolio on a self-directed basis, but still want true advice, we work with our advised parts of our company, Merrill and the private bank, to make sure those clients get what they need from a more robust, full-service model.
Aaron, wonderful to catch up, as always. Come back soon, and we'll continue the conversation. Yeah. Thank you, sir. Aaron Levine there of Bank of America on the latest push. If you'd said this to us maybe 10, 20 years ago, 95% of interactions on the digital platform, I think we'd be talking about a much, much smaller physical presence. And to Aaron's point, it's got much smaller, but the effort, the emphasis has shifted as well. The way you use this physical platform now is very different to what it was used for 20 years back.
You know, it is financial therapy, and you think about the emotional, and you can laugh, but the truth is people have a very emotional response when it comes to money and where they put it, especially after the financial crisis. Think of all those people who grew up having put their savings in the stock market because they were supposed to, because that's what everyone said, and then they lost half of it in 2008. Sure. It changes people's perceptions, and it sort of raises this question, how do you pry the cash out of their hands?
You provided therapy this morning.
And traffic.
Right?
And traffic and auctions.
Therapy, auctions. Isn't it usually fear that you sell?
Well, it's you've got to sort of start with the fear, recognize it, and go to therapy.
And then they go to Bank of America for therapy.
Then you decide, take your
cash
and put it into assets.
All right. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Citigroup's plans to expand in China have hit a roadblock after the Federal Reserve imposed a penalty on the bank for its data management and risk controls, according to people familiar. Now, Citi is facing delays since Chinese authorities require a clearance letter from the Fed verifying its regulatory standing. Sources tell Bloomberg Citigroup is continuing its discussions with China's securities regulator to set up the business and has no plans to pull its application. Meanwhile, at the box office, Beetlejuice beat newcomer Transformers 1 this weekend. The horror comedy has taken the top spot for the last 3 weekends, taking in $26 million, according to Variety. Demi Moore's body horror satire, The Substance, took 6 plays in its opening, earning the actress positive reviews and some Oscar buzz. And the Chicago White Sox making baseball history this weekend, but not in a good way. The team losing to the San Diego Padres to tie the post-1900 Major League record of 120 losses that was set by the 1962 expansion New York Mets. As for the present-day Mets, they're looking to lock in their place in the postseason with a major series against the Atlanta Braves starting on Tuesday. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Just a little bit of a check on the market for you. Equity futures on the S&P 500 firmer by 0.1%. In the FX market, the euro down to 111.24. The data out of Europe, not great. We'll talk about the other side of the trade up next with Eric Nelson of Wells Fargo.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Stocks just a little bit firmer, up 0.1% on the S&P 500. If you check out the FX market, the euro weaker this morning against the dollar. Euro dollar 111.22. Here's the latest. The dollar facing an uncertain future ahead of the presidential election. Eric Nelson of Wells Fargo saying this: under a Harris win with divided control of Congress, we expect the mix of reduced uncertainty and tighter fiscal policy to increase the room for Fed rate cuts, implying an earlier shift to a weaker dollar. Eric Nelson joins us for more. Eric, good morning.
So let's talk about one. Here's a question that's near and dear to your heart. You have a lot of children.
Yes. I'm trying to set a good
example. The birth rate is down in the U.S. What needs to change so people start having more children?
Yeah, so this question has troubled me for a long time, because you can look at the demographics. It's a very slow-moving ship. I mean, you know who's going to be an adult in 20 years based on who was born last year. So, if you want to, I think, have a good approximation for population, really look at how many babies were born last year in a particular country. Multiply that by life expectancy. That's the number of people that will be adults in that country. That's the steady state population if birth rate remains constant. Now, birth rate is not constant, it is dropping. So you look at the second derivative of birth rate, and actually we see an acceleration in the drop in the fertility rate. Second derivative of the fertility rate is very bad. So where does this lead? This does not lead to a greater civilization. This leads to a civilization that potentially dies not with a bang, but with a whimper in adult diapers. That is a sad ending.
So obviously we have countries that, like Korea, used to have a birth rate of 6, it's now 3/4.
Yeah.
Here's a light question for you. What do you
come
think
pick me
are
up,
the
I'll
biggest,
give you a baby, says one
what
of
do you
the...
think are the...
That is one of the things that says on the screen.
I don't know if everyone heard that. You want to read it?
It says, Elon, come pick me up. I'll give you a baby. Thank you.
Okay.
Well, I mean, I certainly encourage everyone in this room to have at least 3 children. Look, baby's got to come from somewhere, you know. I think we just want to have, I don't know, I think we want to have like a slightly increasing population, not a plummeting population. You know, and I think this applies to all countries and cultures. Like, I don't think we want any country or culture to disappear. We want them to ideally flourish and not disappear. So, in fact, one of the things that is overlooked by probably most historians is the role of low birth rate in the decline of civilizations. So around, I think it was around 50 BC, Rome passed a bill to give a bonus to any Roman citizen that would have a 3rd child. So this was birth rate was a problem in Rome in 50 BC. The Romans weren't making Romans. The same is true of ancient Greece. So there was a time from about 800 BC to 300-ish BC where the Greeks had a lot of kids and a lot of surviving kids. Like the birth rate far exceeded the death rate, which is why you had Greek cities popping up all over the Mediterranean. But then I think basically it seems to be that prosperity destroys the birth rate. So when a civilization feels like it has no meaningful external threat and is very prosperous, that is what causes the birth rate to plummet. Somewhat counterintuitively, you think, well, if you've got more resources, surely that would lead to more kids. In fact, it is the opposite. The more prosperous a civilization, and the more a civilization feels that it does not need to defend against external threats, the lower the birth rate.
They've, of course, faced a very difficult decision earlier in the year from the Constitutional Court in Germany. They can't do a lot on the fiscal side. They're actually tightening the budget because they have to. So not only is monetary too tight, but fiscal is actually getting tighter.
How much harder is it going to be for Germany if we get a former President Donald Trump in the White House?
A lot harder. Yeah, and I think people underestimate how much worse this can get before it gets better, right? It's not as if, you know, as soon as Trump comes in and there's a threat to the European region, there'll be some massive breakthrough on the fiscal side for the EU at large, right? You know, Germany's, like I mentioned, the politics are challenging there. There is an election next year. Maybe there's some hope for a centrist, kind of stronger, you know, Merz to come in, but he's going to have a difficult time if he wins putting together a coalition government that wants to do big spending, right? There's a lot of hurdles here, so I think it can get worse before it gets better.
Is the former President Donald Trump dollar positive?
I think at least initially. I mean, the tariffs and the trade is, if you look at one thing that man has been consistent on for decades, trade and tariffs, right? And he still has Lighthizer in his circle, and we know he is the architect of all of this. So that's probably going to come through. Whether there's going to be policy around, you know, trying to weaken the dollar, we heard this kind of noise back in 2017 and 18, right? You go back to there's headlines about the Mar-a-Lago Accord, you know, the New Plaza Accord. I'm not sure this is really going to be something that's going to be policy, and I'm not even sure how they would achieve a weaker dollar. So I think the trade and tariffs is what you focus on, that's dollar positive.
So what kind of levels are you thinking about now? Just frame the range for us going into next year.
Well, I think if we see Mr. Trump come back in and you see really the European economy continue to fall over, I think 106, 107 is in play. I think parity is probably out of reach, you know, barring the absolute worst case scenario for everything. But I think if you see Harris win, you can see things stabilize closer to 108, 109 and start to see it turn higher again, just from, you know, I think that the U.S. fiscal consolidation and the lack of trade and tariff risk coming through.
So Trump is a stronger dollar, Harris is a weaker dollar in your view. What's gridlock?
Well, I think if you look at something like dollar-yen, that's where it really shows up, right? Because the baseline here, if you don't have any congressional action over the next 2 years, is fiscal tightening, right? Okay, we're not going back to a 2 or 3% deficit. From 7 to 8 to 6 to 5, that's a meaningful swing, right? And so I think you see dollar-yen really start to participate in that next move lower as rates, you know, really start to adjust lower. Fiscal concerns don't go away, but they abate.
You're here from London. Is there going to be another Liz Truss moment somewhere else? And we talk about this because everyone talks about the deficit and when that could actually affect the U.S. in some sort of dramatic event. Do you foresee that? Do you talk to clients about that? Do they ask you that?
Sure, yeah. I mean, look at France just in the past couple of days, right? We're seeing but I mean, I think it's important to separate. We all want to kind of think about sort of benchmark to recent events. And I think the Liz Truss moment was very much more about financial kind of linkages and the LDI issues as much as it was the fiscal, right? That was the spark, but really the kindling was already there. So I think with something like France or even the US, without that LDI kind of component, it's hard to see a sudden 200 basis point move in yields. But look, fiscal concerns are real. We talk to clients about this all the time, and they're not going away, right? Even in the US, if you go from 7 to 5, I don't think we're going back to the balanced budget era of the 90s anytime soon, right? So I think it's going to be a concern for a while.
Is it 2 years since Truss?
Exactly 2 years.
Where's 2 years gone?
It's the anniversary of Lisa's favorite moment in financial markets.
Flown by.
Look at you. We're halfway through 2020. Where'd that go?
I know.
I know. It's just very much a theme this morning. I will say, though, yes, it does feel like it was just yesterday, in part because it was the first time we've ever seen fiscal actually matter in such a dramatic fashion after so many warnings. And I think it was refreshing to some vigilantes.
The Starmer government communicates like it was just yesterday. I'm not sure how misplaced that is. Eric Nelson of Wells Fargo, you can save that opinion for another day. Coming up on this program, Liz Young-Thomas of SoFi, Vijay Rakesh of Mizuho, Pooja Sriram of Barclays, and Bob Elliott of Unlimited. Look out for that in just a moment. Equity futures on the S&P 500 still just about positive by 0.1%. In the bond market, 10-year yields climbing for a 5th consecutive session. We're up a single basis point.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are 3 fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number 2, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number 3, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Market wanted 50, it got 50. I think the key now is, can yield stabilize?
Overall, the economy is performing like it doesn't really get impacted by kind of these swings in rates we've had the last couple of years.
The Fed's trying to get to neutral. It's just it doesn't know where neutral is.
The idea that the Fed simply through its actions brought down inflation, this is nonsense.
I do think that we are headed for a soft landing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Paul Donovan, UBS, love it. Just one of the very best. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell. Your scores look like this on the S&P 500. Equity futures pushing just a little bit higher by a basis point or 0.1%. On the Nasdaq right now, we're up 0.2%. On the Russell, the small caps up by 0.4%. Speaking of basis points, up for a fifth consecutive session on a 10-year yield. Lisa, once again, that curve is a little bit steeper in America.
Introducing just a little bit of fear that maybe inflation isn't as dead as some people had proclaimed it. But little fear is sort of the operative word here. We're seeing that in gold as well. Key question here is, given that the data is very much in the driving seat, will it point to a greater risk of a downturn? Will it point to the soft landing that's widely priced into markets? Or does it point to that concern that some people have been raising increasingly about just a little bit of a tick up in inflation?
So let's turn to the Fed speak and let's get to the calendar. It's a lot of Fed speak over the next week. You're going to hear from basically everyone. Pretty much everybody, including Raphael Bostic of the Atlanta Fed, who says a 50 basis point cut does not lock in the cadence of future moves, echoing what we heard from Chairman Powell in the news conference just last week. Others suggesting that maybe they're ready to go another 50.
Neil Kashkari coming out today in an essay where he said he does see a case to be made for an additional 0.5% rate cut this year, talking about how the balance of risks has shifted away from higher inflation and toward the risk of a further weakening of the labor market. This sort of goes and underscores the concern that we hear on the Fed that seems to outweigh what we're hearing with economists who seem to say that the U.S. seems to be chugging along.
Stuart Kaiser was absolutely correct. The question still remains. No question was answered. Now it feels like we're going into the next Fed decision, which is after the U.S. election, with the same question, 25 or 50. And we're not getting an answer right now. But you mentioned Paul Donovan of UBS. He says markets want to hear that the Fed is scrambling to catch up with falling inflation, not that there's anything wrong with the economy.
You'll remember that Governor Mickey Bowman dissented this decision last week. She said going into the weekend, the committee's larger policy action could be interpreted as a premature declaration of victory on our price stability mandate. It's pretty obvious what her concerns are.
Which is the reason why she dissented. Some people would say it was a carefully orchestrated dissent in order to create this feeling that this isn't necessarily going to support 50 basis points in tandem in consecutive meetings. Pooja Swaram coming up later this hour, talking about the cost of this insurance policy. I think it's a really important point, and it goes to communication. The idea that this was sort of a toss-up going into this meeting until a series of articles, and I know people are thinking you're still harping on that, but it raises this question. Is that the cost? That essentially people are going to be looking to communications to give you a sense of where the committee is going to go, and that is prescriptive and actually determinative and not necessarily just a reporter writing.
Are we data dependent or journalist dependent in the quiet period? Is that what you're asking?
It just raises a question, and that cost of what she calls Fed credibility, and other people, if you're raising this too.
I totally agree.
It raises a real question that I think is an important one to discuss.
If you are a professional forecaster, I think the last month has made life very, very difficult for you because you were focused on the economic data. A great example was Andrew Holmhorst and a team over at Citi who had 50 baked in, looked at the economic data, which seemed to be okay, went back to 25 and they cut 50 anyway. So if you're trying to forecast this stuff, it's much harder to do now.
The economic data didn't materially shift. They say that they're data dependent, but one thing we keep raising is that data dependency has a very difficult meaning when you can interpret the data however you want to. And if they had come out and they had cut rates, or if they came out and they said, look, we made a mistake, which is essentially what he did say, in all fairness. He did say, you know, we should have probably cut in July if we'd had that data in advance. So this was a catch-up. You know, but it just raises this question about how predictable some of the future moves are going to be.
There was a great line out of SocGen in the last few months. They talked about data independence. Never mind the data dependence of the Federal Reserve. They talked about the data independence of the ECB. Why aren't they cutting by more? This data on the PMI is just absolutely awful today. The euro's down by about 1/3 of 1% to 111.19. And this is the question you keep hearing on the continent from teams, time and time again, from market participants. Why aren't they cutting by more, given the downturn we're seeing across the continent?
I think you're right to point that out. We can be critical of the Fed in whichever way we'd like to, but the bottom line is people should be pointing the finger at the ECB right now and saying, you're looking at an economy that's contracting in manufacturing at the fastest pace going back to the end of this year and continuing to decline, and it is structural. And they're talking about, well, it could go either way. You know, I mean, again, it's sort of, if the U.S. Federal Reserve was going to do that, can you imagine? You've raised this point.
Yeah, I think we'd be in a much bigger mess than we are, and thank goodness the Federal Reserve is not doing what the ECB is doing right now on that particular issue. Anyway, coming up this hour, we'll catch up with Liz Young-Thomas of SoFi as markets await more economic data, Vijay Rakesh of Mizuho as Qualcomm explores an Intel takeover, and we'll speak to Pooja Sriram of Barclays on the Fed's 50 basis point recalibration and the credibility hit they might have just taken over the past week. We begin this hour with investors awaiting a calendar packed with Fed officials. Liz Young-Thomas of SoFi writing, the tone of this game has changed from pause to cutting, from hot to cooling, from tight to balanced, and from inflation to jobs. That calls for a change in market tone as well. The more defensive parts of the market and the rate-sensitive sectors have won out, and I would expect that trend to continue. Liz joins us now for more. Liz, welcome back to the program. Let's talk about that very specific trade. As you know, those bond proxies, the utilities, more to the utilities trade than just that, I know, but they've had quite a run year to date. Liz, do you think we need an extension of the bond market rally to support those trades, or is this enough?
I think the bond market rally and the equity market need to happen in tandem, and they need to make sense rationally for what's going on in the economy. So let's just be specific, though, on utilities. Part of what's happened in utilities and the rally that we've seen in utilities is because they started to be looked at as an adjacent trade to the AI theme. So there has been some upside and perhaps some multiple expansion in utilities names due to that. I say that as a warning where if the AI trade loses more steam, or if some of those large cap stocks give up gains, you might see a pause in that utilities rally or a give back in the rally. The reason that I've been pointing out these defensive sectors and the ones that have done well, rate sensitive and defensives, are because in this particular environment where you've got a yield curve that is steepening, you've got a Fed that started cutting, you've got on the precipice of money market rates coming down for investors and the income that we've been used to getting out of risk-free assets likely coming down, not dramatically, but coming down, you're going to see those dividend players, and you should see those dividend players pick up, and you should see investors make rational decisions about where to find income outside of some of those really rate-sensitive money markets, CDs, and maybe even treasuries at some point.
Let's just build on that. As the curve starts to normalize and people start to look every single month at the income they're now receiving in a money market fund and say, okay, it's time to do something, are they deploying that cash out along the curve and taking duration risk, or do you actually think they are going to look to the equity market for that income?
I think both would be a good idea at this juncture, but I want to also be clear, this is not something where we've decided that we've secured a soft landing. So if you decide that you've secured a soft landing, you deploy money in the equity market, but more to riskier and cyclical parts of the market. I don't think that we have decided enough yet that that should be the case. So if you're going to deploy assets right now because you're worried about rates coming down and you've got a lot tied up in a money market or in something that's risk-free and you're worried about the income going away, I think you can spread it among the shorter end of the curve, because I would expect that to continue to come down as this cutting cycle carries on. But you can also put it into parts of the equity market that should do well, at least in the beginning of a cutting cycle, which continue to be things like financials, REITs, utilities, staples, healthcare. Be a little more careful with healthcare in election year, but I still think healthcare and things like medical devices should do well in this environment. It's also worth pointing out the 2s-10s curve today, the last time I checked just a couple minutes ago, is positive by about 17 basis points. That's the biggest positive spread we've had in a very long time. So that's the point I was making in last week's piece about this market environment has changed, and it requires investors to look at their portfolios and make sure that they're positioned for what is now to be a different market environment. That doesn't necessarily mean a bad one, but different from what we've experienced for the last 1.5 to 2 years.
What would you have to see, Liz, to get more excited about the idea of a soft landing, to sort of leverage the wagers a little bit more on that?
Well, look, I think the 50 basis point cut gave us a better chance for a soft landing. So that did encourage me, and I applaud the Fed for going big, especially on that first move. I would need to see for at least the next few months the data cool but not stop. My concern is that we've hit this point in the economy where we're very balanced right now. Things look good right now. The consumer is still healthy. The labor market is balanced. Inflation readings have come down. Things feel good right now. We are not overheating. But my concern is that we're just making a pit stop in this balanced level on our way to weak. And what we don't want is for that to surprise markets and surprise the Fed. So I don't want people to declare premature victory, premature soft landing at this point. I think we still need to get quite a few more readings, particularly on the labor market. I think the labor market holds the key for the rest of the year.
If the risk is to the downside, Liz, why aren't you recommending that people take their cash and put it into the long end?
Right now, I think there is more volatility on the long end because of this large cut in the beginning and because there is still a gap between what the market expects and what the Fed is saying they're going to do for the remainder of the year. So the market is pricing in 3 more 25 basis point cuts. The Fed is not entirely sure that that's going to be the case. So if we hit a point where inflation starts to heat back up, and it sounds like there are even Fed officials with that concern right now. If inflation starts to heat back up, or if we see a major resurgence in maybe consumer spending, or if we see an uptick in commodity prices, I think the long end of the curve is going to see more volatility.
Let's just build on that, just to finish. The balance of risks around that story. Do you think there's equal amount of risk to a re-acceleration in this economy as there is to a downturn?
Personally, no. I think there's more risk to the downside, particularly in the labor market. And I think at this point, because of how we got to balanced and because of how inflation has come down, first in the goods portion of the economy and then in the services portion, we've still got shelter holding it up. But I don't think there's as much of a risk of an overheating due to demand. So I want to make that distinction very specifically as well. I think that consumers have pulled back enough that even aggressive rate cuts shouldn't fuel an overheating again in the economy that makes demand outstrip supply in some of those categories. Where the risk is on a inflation reheating, I believe, is in the commodity complex. So if you see things like oil come back, if you've got metals that go up somehow dramatically, if there's a global shock, which there's always, of course, a risk of, I think the bigger risk in inflation is really about commodities.
Interesting. Liz, we'll leave it there. Wonderful to catch up as always. Liz Young-Thomas of SoFi, that final note there on the commodity market.
Yeah, although I wonder how difficult it would be to get that resurgence in inflation coming from commodities unless China gets some sort of stimulus package. I mean, this sort of goes to the question of how much could shift after the election is over as people start to make the moves that they've been holding off on.
All roads at the moment in every conversation seems to lead to China. And right now they're exporting disinflation. Bob Elliott of Unlimited is going to join us at 8:30 Eastern Time. Look out for that conversation. We'll focus big time on that. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Congressional leaders unveiled a stopgap funding bill yesterday to keep the U.S. government open through December 20th. Negotiators are working to avoid an October 1st shutdown and set the stage for a funding showdown shortly before Christmas. Lawmakers aim to vote on the measure by Wednesday. Meanwhile, Boeing ousted its defense chief Ted Colbert over the weekend. The move is one of the first major shakeups by CEO Kelly Ortberg, who took over last month. The defense division has been losing billions of dollars in cost overruns and saw negative headlines after NASA decided it was too risky to use Boeing's Starliner space capsule to bring 2 astronauts back from the International Space Station. The company is also dealing with its second week of a strike. And U.S. billionaire Dan Friedkin is closing in on a takeover of Everton FC, according to people familiar. The deal would bring an end to months of uncertainty at the Liverpool-based football team. Friedkin, who also owns the Italian club AS Roma, held exclusive talks before announcing in July that he wouldn't be proceeding with a takeover. Everton is moving to a new 53,000-seat stadium next year, which it hopes will boost revenue. That's your Bloomberg Brief. John?
Yahira, thanks for the update. Thank you. You'll hear more from Yahira again in about 30 minutes. Up next on the programme, the Morning Calls, plus Qualcomm floats a friendly takeover deal for Intel. That conversation up next.
There is this real momentum from Wall Street.
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
Live from New York City, your equity market firmer by 0.1% on the S&P 500. In the bond market, yields a little bit higher for a 5th consecutive day, 375.65. Gennady Goldberg over at TD. We would look to be buyers on any significant move higher in rates and still expect 10-year yields to finish the year at 350.
To me, this is the big question. At what point do people start more aggressively buying the long end? And if they don't, how surprising is that, given some of the longer-term projections that we're hearing from the Fed themselves?
If you believe there's going to be this great slowdown, if you believe if the Fed's going to be wrong with the dot cut, ultimately it's going to be wrong because they're too high and not too low, then ultimately isn't it a buy?
Well, that's the reason why it's sort of surprising that we haven't seen actually more buying action. And I will just say, $44 billion of 7-year notes coming on Thursday. Watch it.
Watch out. That and the traffic update as well, which I've
that
absolutely loved from Lisa this morning. The average traffic speed in New York City this week, 3 handle.
in Midtown is 3 miles per hour, but Gridlock Sam says that it does sometimes average
Who's
0.
Gridlock Sam?
Gridlock Sam.
On Twitter?
No, Sam Schwartz. He's known as Gridlock Sam.
Never heard
He
of him.
tracks this from the Department of Transportation.
Appreciate the update.
Gridlock Sam, we
Because you
welcome
don't drive in New York. John takes the
I do
metro.
not. Do you drive in
Midtown either.
Midtown New York? No. Let's get you some morning calls. First up, D.A. Davidson cutting Microsoft to neutral from buy, saying the company's AI lead has diminished. The stock is down by about 0.5%. Your second call from Bernstein cutting General Motors to market perform from outperform. Data suggesting there might be rising earnings headwinds. That stock is down by 2.8%. And finally, Citi raising its price target on Meta to $6.45 and keeping a buy rating on the shares. Meta remaining the firm's top pick across the internet sector. That stock is up by 1.2%. Let's stick with tech. Intel in the spotlight. Sources telling us here at Bloomberg that Qualcomm has approached the chip maker about a potential takeover deal, and now Apollo Global Management making its pitch, offering an equity-like investment of as much as $5 billion in Intel. Vijay Rakesh of Mizuho joins us now for more. Vijay, some big changes going into the weekend and coming out of the other side to start this week. Of these offers on the table, if they do evolve and materialize, which one do you think is more attractive to the firm?
Yeah, thanks for having me on, John. So the Qualcomm takeover of Intel, I think it looks like Qualcomm is trying to diversify. It's good for Qualcomm, but the problem is the price tag might be too high to afford. If you look at the sum of parts on Intel between the PC business, the server and data center, AI, etc., it comes to almost 186 billion on a sale price tag at the least, versus Qualcomm market cap about 188 billion. So they have to definitely look for some pretty big financing to make this acquisition. But also, I think if you look at Intel, they have 53 billion of debt and a negative 20 billion free cash flow. So there are some massive challenges in looking at that acquisition. So that's definitely a challenge, but something like a private equity investment is much smaller at 5 billion. It's more palatable, something that Intel is definitely shopping around. And they've had prior investments into the Ireland fab as well. So that looks something that is manageable.
Vijay, the regulators watching on, what do you think they'd prefer to see?
Yeah, I think it's a mixed bag. I think if you look at Intel, it's definitely a national asset, and I think they have been they are the pillars of manufacturing in the U.S. So definitely want to keep it in the U.S. So, but for Qualcomm to come in, it could invite FTC scrutiny in terms of having both ARM and x86 and multiple other technologies in-house. But also you could see pushback from peer semiconductor companies as well, similar to what we had in the prior NVIDIA ARM acquisition. And lastly, I would say China, right? I think China MOFCOM, that they might need approval out in China as well, given Intel's exposure in China. So there are some challenges on the regulatory side for sure.
What's the benefit for Intel? I mean, why do they need a white knight at a time when not so long ago they were the national champion?
Yeah, I mean, I think if you look at Intel, they had been the manufacturing leader, they had been the technology leader, but over the last 5 years, they've lost their way. I think CEO Pat Gelsinger has focused on the 4 nodes in 5 years, but it has failed to deliver market leadership in PC or servers, meaning they've lost share in PC and servers for the last 5 years to AMD. That's not translated to real market share gain or profitability. Margins are down. Free cash flow is at negative 20 billion. And going on to the foundry side, it's a long-term vision, it's a long-term roadmap. And that even looking out for, out to 2030, they talked about a 15 billion revenue from that on the foundry side. So that's still pretty small compared to what TSM is doing, let's say today, somewhere in the 40 billion plus. So I think they have long ways to go. There are some challenges there. They lost their way on the market side and technology side and the manufacturing side, and so that's where we now end up. So,
when it comes to the regulators, are you saying that it's merger dependent on what basically they'll allow through?
Yeah, I think when you look at Qualcomm itself, they obviously have their financing challenges, as they mentioned, but they might not be as interested on the foundry side because they have a pretty good strategic foundry relationship with TSM. But if they were to look at the other segments, PC, data center, etc., the question is how much consolidation or how much concentration do they allow Qualcomm to have on the PC side or on the server side? And so that could be where the challenge is for for Qualcomm from FTC, just a US FTC regulatory standpoint. There could be other global regulatory challenges as well. There could be pushback from other peers as well who want to step in and take some of the assets. So,
Vijay, I'm just curious, which would you put your money on in terms of Apollo versus the potential for a Qualcomm takeover?
Yeah, I think Apollo is a much easier one. I think it's much more manageable, as we mentioned early on. But I think, I think Qualcomm, there are a lot of hoops they need to jump. And so I think that's a little bit more of a challenge. But the Apollo one seems like a much easier one for Intel to do.
How long would it take for U.S. National Championship to really compete with TSMC?
Boy, that is a very good question. I think it'll take a long time. I mean, it'll probably take in the neighborhood of 5 to 10 years at the least, because obviously Intel first has to regain its technology leadership, and then they have to prove their technology leadership, because I think that's a leadership that's earned. It's not something that is given. And so I think there are some challenges there. They definitely have to get ahead of TSM, but also be price competitive. So there are significant challenges, and TSM obviously is based in Asia. They have access to much cheaper labor and much more qualified labor in many cases as well, versus a much higher cost region in the US for Intel. So there are some challenges there. So we think it could take a little bit of time.
Vijay, just quickly, and I understand this might put you in a compromising position, but have you been surprised there hasn't been a management change at Intel?
I think CEO Pat has his challenges. I think he has been there 3 years plus, and so there is some investor concerns, investor angst around it. The board has definitely stood by him, but I think the continuing challenges definitely pose some concern for management and for and I think I think the investors are definitely in that docket as well. So,
well, thanks for sharing your opinion with us this morning, sir. We appreciate it as always. Vijay Rakesh there of Mizuho on the difficulties and the opportunities that confront Intel this Monday morning.
You ask a really good question, which is how have we gotten here without some bigger wholesale changes, given some of the fallbacks in some of their strategies?
Talk about the difficulties with this firm all the time.
I know.
Every single earnings season.
Yeah, and the hopes and dreams for this to really become a real competitor with TSMC.
Pooja Sriram of Barclays up next, alongside Bob Elliott of Unlimited. That conversation just around the corner.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Max Kettner, HSBC. Take a listen to this line. There could be a non-negligible risk of a growth uptick and threat to the disinflationary progress in the coming quarters. This leaves short-term inflation and terminal rate expectations too low relative to economists' forecasts.
This is the risk case that you're feeling tick up in gold, although some people might say, why are you watching gold, or even the long end of the yield curve, and you start to hear it around the edges. If the economy is as good as it looks now, it doesn't turn down, well, what's on the other side of that?
Things right now seem to be okay. Equities are positive by 0.2%. Nothing to see here, Bramo. Gold very close to all-time highs. On the Nasdaq 100, we're up by 1/3%. 1 hour away from the cash open with some morning movers. Let's get across to Manus Cranny. Morning, Manus.
Jonathan, very good morning. Yeah, and Max Kettner, when he was here just a week ago, very bullish on U.S. equities. This is how we start the day on Intel. You spent a bit of time on this, but I just want to put this to you, which is, one is a potential bid from Qualcomm, which is about taking this asset, taking it apart, and it is a sum of the parts friendly bid. The other is an offer of an equity slug, $5 billion into this company from Apollo, a deal and a company that they know very, very well because they did an $11 billion deal just a few months ago. So one is about potentially taking this company apart. The other one is very much a vote of confidence in the offer of an equity slug. We'll see how it plays out. Let's roll it forward and have a look at GM, never far from our mind. This is Bernstein. They downgrade the stock, Jonathan, this morning to from outperform. Now, what they've said is, not only are they downgrading the earnings, there's an inventory build here in the USA, and also they may need capital in the back part of the autumn. Just turn it around in your mind. Mary Barra's had to step back from electric vehicles, from that big banner of a million electric vehicles by 2025. Let's close it off with technology. It's a wraparound. This is one of the biggest nuclear players in the United States of America. They're going to revive a plant in Pennsylvania. They're going to put in $1.5 billion. And what are they going to do with the power? They are going to sell it all to Microsoft on a long-term deal. This is the very personification of hyperscalers and what they need from the energy industry in the United States of America. Jonathan, good morning.
Manus Cranny, thank you, sir. Timely. Energy demands sky high on this front.
And how much do you end up having private adjustments made with specific tech companies trying to contract for their own energy uses to offset that? We've seen that to a little degree over the past few days.
We spoke to Baker Hughes recently as well, talking about off-grid solutions. The stress on the grid, the demands on the grid are going to be absolutely humongous over the next several years off the back of this story.
How do cloud providers ensure that no breakdowns occur for their clients? And how can they ensure that unless they get some of their off-grid solutions, like what we've heard about recently?
Let's turn back to the markets. Equity futures right now up 0.25% on the Nasdaq 100. Looking ahead to a busy week of data and Fed speak, Pooja Sriram of Barclays saying the following: even the 50 basis point cut appears to have been a close call. The outcome bears the distinct imprints of a compromise, with hawks trading the 50 basis point cut in favor of hawkish messaging and a relatively high bar for the unemployment rate to warrant another aggressive cut. Pooja joins us now for more. Pooja, I just want to get to your growth outlook, and I just want to sit on your GDP outlook. Did you raise your GDP outlook after getting that surprise move from the Fed last week?
We did. Good morning, first of all. We did raise it by about 0.5 percentage points for the end of Q4. So we're still penciling in 2% growth for the fourth quarter of this year. And then we've got a similar pace of growth, in fact, through the end of next year. Some of that was, of course, the easing in financial conditions that we've seen over the past couple of weeks. We track the Fed's FCIG measure, which translates financial conditions into the impulse for growth. And it does suggest that growth could look better. So yes, to your question, we have raised our GDP forecast modestly in the near horizon. Yeah.
How does that line up with your view on the Fed's next move and the moves through 2025?
Yeah, that's a good question. So look, our own baseline is for 225 basis points cuts this year. So that's, broadly in line with the median projection for 2024. For 2025, we've got 325 basis points cuts. So that's a total of 75, as opposed to the 100 basis points cut that the FOMC median has. And that's really predicated on the view that, the economy is going to look pretty decent. We don't have the unemployment rate staying, at 4.4%, which is what the FOMC has. We, in fact, do see it ticking lower. So we do think that, they could afford to slow the pace of rate cuts going into 2025.
Pooja, you wrote something in your recent report that I thought was fascinating. Whatever was gained by the Fed's 50 basis point rate cut may have come at a significant cost. And you go on to say that it seems quite likely that similar Wall Street Journal articles, akin to what we saw ahead of this latest 50 basis point rate cut, during that blackout period coming up, any blackout period, will be interpreted as legitimate signals, leading to unnecessary noise. This cost may well exceed whatever benefit the Fed achieved by front-loading one cut, in our view. Can you just elaborate on how much this adds to potential uncertainty for you?
Yeah, I think that's a great point. So, just to take a step back and to recap what happened, before the Fed went into the blackout period, we had a bunch of data in hand. I think the last print we had was, the non-farm payroll. We heard from FOMC officials, namely, Waller, FOMC member Williams, and the markets were essentially quite content to price in a 25 basis points rate cut. That was our baseline as well. Everything looked good. And then, as you mentioned, we got a bunch of these articles, and suddenly it raised the question and, put the possibility that the Fed could perhaps, go a little more aggressive and go 50 basis points. And then, the pricing moved. And surprisingly, the Fed actually ratified that move in market pricing. And we found that quite surprising, to be honest, because it did not come on the back of data, and in fact came on the back of a bunch of articles. And what this means is if something like, if there's a precedent for this now, it's quite possible that there's going to be a lot of noise and volatility around the blackout period if we get more news information this way. And in terms of the fact that the Fed did not gain much is, the markets are still pricing in about the same amount of rate cuts as they were before the news articles came out. So it's not very clear to us what the Fed achieved by ratifying market expectations going this route.
This might sound like a dumb question, but what is the actual economic cost, though, of a little bit more volatility around the blackout period?
Well, I think it can get markets to run away with expectations. It's you would think that the data, hard data on economic activity, what you're officially hearing from the FOMC guides market expectations. But if you have something like this, it can lead to a lot of volatility. Market pricing could go different ways. And then if the Fed outcome looks very different to how the markets have moved, it can create financial market volatility. So I think that was the point that we were trying to make, that it creates unnecessary noise, especially after an era where Fed communication has been really on point and they've really made an effort to do this so well.
Given this, do you think the Fed now has a credibility problem?
Doesn't seem like it. When we think of monetary policy credibility, we do tend to look at inflation expectations, right? The credibility comes from the fact that how committed are they towards their dual mandate. And right now, there's no question that they're very committed It does seem like the focus is a little bit more on the labor markets than it is on inflation, as it should be, given the inflation outcomes are pretty good. So I think it's too early to start questioning any of that. But it does create a bit of a kink in the communication policy.
Pooja, we've got to leave it there. Appreciate the catch-up. Pooja Sriram there of Barclays. With us around the table to continue the conversation, Bob Elliott of Unlimited. Bob, good morning and welcome to the programme.
Good morning.
What did we achieve with a 50 basis point rate cut last week at the Federal Reserve?
Well, I think the biggest thing that the Fed highlighted was that they were trying to paint the picture of a strong economy and sufficient disinflation that they can deliver big cuts relatively quickly into that scenario. Now, you can argue whether you actually believe that that's true, but I think the path that they're laying out, they're committed to, and they believe it's data-driven because they believe that the inflation numbers are going to get back to their 2% mandate. And that's very interesting for markets. It might be too easy into a hot economy, which has got a lot of effects, second and third order effects that they might not expect.
Are you a believer
in disinflation? No, probably not. I think the thing that's interesting, inflation is still running above the Fed's mandate. We have to remember that, no matter how you slice it. And easing into that environment when you have a hot economy means that we're probably more likely to get acceleration rather than deceleration ahead. The thing that's interesting about that is that the Fed probably won't see that data come out until they've cut a few hundred basis points. And only then will they be held accountable for the fact that the disinflation might have reversed. And so I think it's a tricky period over the course of the next 15, 18 months when the Fed isn't going to get the feedback loop that their policy is too easy.
Just to put a bow on that, are you saying that right now the risk of a reinflationary kind of moment is greater or less priced into a market and more real than, say, a downdraft in growth?
Well, certainly it's less priced into markets. When you look at long-term inflation expectations, the expectation is for inflation to be at 2% or below 2% essentially forever. And given the geopolitical dynamics, given the Fed's easing into a relatively strong economy, given the fact that you still see a lot of sticky dynamics in inflation, particularly related to wages, which are showing some signs of reaccelerating, that whole picture doesn't really align with the probabilities of, a certainty around 2% inflation, and much more likely that we have higher inflation ahead rather than lower inflation.
Normally somebody with that kind of view would be bullish, because if you believe in this sort of strong economy that could foster some reignition of inflation, that would be probably positive for equity valuations. But you wrote the stock market is priced to perfection. And so far this quarter is providing plenty of data points that the perfection is unlikely to be achieved in reality. Why?
Well, I think when you're trading markets, you got to trade against what the price and expectations are. And we're at PEs that are, almost as high as they were during the tech boom. We have forward earnings growth expectations in the mid-teens. That's a pretty strong scenario, already priced into the markets. Now, the Fed is helping that along, and that's probably a positive. But I think the story is much more around being long stocks relative to bonds, because that's the scenario, of the growth reacceleration that probably isn't fully priced into the market.
Let's introduce China into the conversation. They're now exporting disinflation, perhaps even deflation. How do they factor into your worldview right now?
Well, China's experiencing debt deleveraging, akin to what happened in Japan and akin to
sort of classic balance sheet recession.
A classic balance sheet recession, and the policymakers there are maybe driven by motivations that are not related to macroeconomic policy, more like political motivations. And so, for whatever reason, they're choosing not to respond to the situation. And so, China's probably in this malaise for the foreseeable future. I think the effects on the West are actually relatively limited, and the reason why that is China's deflationary impulse has been basically the same for the last couple of years. Probably China is not going to accelerate in terms of getting a deeper and deeper or a worse rate of deflation going on in the economy. And if anything, we've seen it tick up. And so the big picture is it's probably not the main story that's going on. When you're looking at U.S. inflation and Western inflation in general, what really matters, it's the labor markets. It's all about the labor markets. It's all about that wage data. If you look at the Atlanta Fed wage tracker data, we're 1 to 2 points above where we were pre-COVID. And unless you believe productivity has matched that increase, that's an underlying inflationary pressure that remains in the economy.
But Bob, isn't the deflationary pressure coming from China has everything to do with the commodities market? Isn't that helping Western economies?
Yeah, it certainly is an effect on the commodities markets. And if you're trading, copper or other direct commodities that China has a meaningful share of, that's going to be a meaningful influence on that supply demand. But the flow through of that to the U.S. inflation picture, it's pretty tiny compared to rents, labor, the other sort of imported, the other sort of imported goods costs that. Cars, new cars, used cars, all of those things represent a much bigger impact on U.S. inflation and U.S. policy.
Liz Young-Thomas, our guest at the top of the hour, was talking about one risk would be reacceleration of commodity prices. Do you see that where China is right now?
Commodity prices have basically been trading, and particularly oil prices, which is really the thing that matters, have been trading in a tight range over the last couple of years after the move down 18 months ago. I don't see meaningful pressures on the upside or the downside. On the downside, you've got a natural cap in terms of suppliers taking barrels off the market if oil prices start to fall a little too much. And on the upside, there's still a lot of incremental production. U.S. production is near all-time highs. A lot of production that can come into the market to put a cap on it. So that's probably not the big story here. It's much more about the sticky inflationary pressures in the economy on the forward-looking basis.
How much would longer-term yields have to rise to make you a buyer?
Well, I think at this point, you've got to see inflation expectations move up considerably here. So I think, easily into the mid fours before you start to have a real conversation that's an attractive bid, particularly relative to stocks in a stronger growth environment.
When you say inflation expectations, you're talking about market-based pricing, or are you talking about consumer surveys, the likes we see from you, Mitch? Every other Friday, what are you looking for? Mostly in terms of trading the bond market, it's all about price and break-even inflation. And so that's the thing that if you look at the markets, basically priced to be at 2% or below essentially forever, or inflation swaps. That's what you're trading. And those are the areas of the market that look particularly underpriced. The reality is, if you're going to get exposure to duration right now, buy the tips. Right, you're seeing real yields that are still pretty good on any long-term perspective. Around 1.5% to 2%. That's a pretty good real yield if you can lock it in for 20 or 30 years without any risk. Bob, it's good to see you. Let's do it again soon. Thank you, sir. Bob Elliott there of Unlimited on this bond market. Bramo, your thoughts?
Well, I think that this is an increasing conversation about, if you believe this economy is strong, then wouldn't you go into stocks and avoid bonds, longer-term bonds? And you get a flavor of that. Even people like Liz Young-Thomas, who's worried about the downside risk, you have a hesitation of buying the long end. This just raises a real question to me about what kind of drama you could see around the election with respect to the long end. And at what point people do come back and buy it if you start to say, okay, the deficit's going to be there, but, what else is new?
No drama right now. Equities positive by 0.1% on the S&P 500 for a fifth consecutive session. Yields a little bit higher on a 10-year. We're up by 2 basis points. The yield, 376. With an update on stories elsewhere, here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Bloomberg has learned that the U.S. Commerce Department is getting ready to reveal proposed rules that would ban Chinese and Russian-made hardware and software for connected vehicles. The announcement could come as early as today. Commerce has been meeting with industry experts in recent months, looking to address security concerns raised by a new generation of so-called smart cars. Meanwhile, the New York Times is reporting that more than 700 current and former national security officials are backing Vice President Kamala Harris. A letter signed by former Secretaries of State and Defense endorsed Kamala Harris and said former President Trump poses a threat to the nation's defense and democratic system. Among the most prominent names were former Defense Secretaries Chuck Hagel, a Republican who served under President Obama, and William Cohen, a Republican who served under Clinton. And the WNBA playoffs are underway with Alyssa Thomas and the Connecticut Sun soundly defeating Caitlin Clark's Indiana Fever 93-69. Thomas posted her 4th career triple-double in the playoffs and 15th overall to spoil Clark's postseason debut. Indiana will look to even the best-of-3 series in Game 2 on Wednesday. Other Game 1 results yesterday include wins by the New York Liberty, Minnesota Lynx, and Las Vegas Aces. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the week ahead, the day ahead, and we'll catch up with Mandeep Singh of Bloomberg Intelligence on the prospect of a big deal in the chip space.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We are 40 minutes away from the opening bell. Equity futures just a little bit firmer, up 0.1%. The calendar for the week ahead, your trading diary looks like this. S&P Global Manufacturing PMI coming at 9:45 Eastern. Later on today, more Fed speak from Goolsbee and Kashgari. Tuesday, the UN General Assembly kicking off. Can't wait. Plus, we'll get consumer confidence. Wednesday, Micron reporting earnings after the closing bell. Thursday, we'll get another round of jobless claims, plus more results from Costco. And on Friday, PCE and UMich sentiment. The stock to watch going into the opening bell, Intel. Shares are rising in the pre-market following reporting that Qualcomm may be interested in an acquisition, and Apollo now offering to make a multi-billion-dollar investment in the company. That stock is up by 0.8%. To talk about this space and a whole lot more in the world of tech, Mandeep Singh of Bloomberg Intelligence. Mandeep, good morning to you, sir.
Morning.
I want to start with this. Will Wade and Dina Bass here at Bloomberg leading with this quote, this paragraph going into the weekend. The owner of the shuttered 3 Mile Island nuclear plant in Pennsylvania will invest $1.6 billion to revive it, agreeing to sell all the output to Microsoft as the tech titan seeks carbon-free electricity for data centers to power the artificial intelligence boom. Is this the beginning of something much bigger in this country?
I think so. I mean, look, there is a clear demand for, building data centers that can train these large language models at the scale that currently, we are not at. And what they're trying to do is focus on renewable energy. So all these large hyperscalers have goals around using, more renewable energy. And look, that's why they are going down the stack in terms of doing it themselves, because they know exactly the configurations for these data centers that they need, what kind of power requirements they have. And I mean, to me, this is a classic case of vertical integration. Microsoft owning this.
With Barclays, every change leads to a bold possibility. You have the vision, we have the insights, financial solutions, and global perspectives to help you make it real. Barclays Investment Bank, powering possible.
Overseeing that, they will get that support, and the government wants Microsoft to build large data centers here because they want to own the data. They want everything to be done onshore. So I think I wouldn't worry too much about the power costs. It's more the chip costs that they have to deal with, and that's why they'll probably go with their own chips at some point.
But to John's point, I understand that they're regulated entities, but if they're going off the grid in order to provide their own electricity, at what point do we have to start to look at the fixed costs that are increasing, that are having to be provided privately by some of these big tech companies in order to provide the reliable service they're promising?
I mean, there's no doubt that, their cost of goods will go up but it's already gone up. And look, the big bet is that AI will drive productivity. Now, you could argue we're not seeing that productivity now, but in their end product, if they can offer a co-pilot that helps you, become 20%, 30% more productive, then companies or consumers don't mind paying for that. So the big bet is with this AI wave is it's going to drive productivity. And you're going to start seeing that 2 to 3 years down the line. Otherwise, you will see some cancellations in terms of, the CapEx plans or what they intend to do in the long term.
Aren't new data centers on hold because they cannot connect to the grid because they're just too powerful? How much is this going to be basically the source of new deals? You have to get your own basically mini grid in order to operate.
Well, so again, I think, yes, they need that power. They need the large data centers set up, and they need big AI clusters. I mean, remember, as long as the large language models keep growing in size and the next GPT-5 version or the Anthropic model is 10 or 15 times bigger, you need more power. And that's where, they will work with all the entities in the chain, whether it's energy companies, whether it's private equity guys. And those are the trends you're seeing right now in terms of, the partnerships that these companies are doing.
You said something about Microsoft and we didn't miss it. They'll develop their own chip. Is that where you would think this is going? And why don't they just buy Intel and just do it through Intel?
Well, so Intel, look, the turnaround of Intel is not very easy. And we have seen that in the last 3 years with Pat Gelsinger at the helm. Nobody is betting on that turnaround. The question is, does Intel have certain pockets that will fit strategically with some other companies? So the PC business is still attractive. It generates $6 to $10 billion in free cash flow. The data center business is losing share to NVIDIA. The foundry business is where it keeps losing money. So maybe Intel is better off, being kind of split in a way where it makes strategic sense. And the foundry business could be useful down the line, but the problem with foundry business is it's losing $20 billion in CapEx. It requires a lot of upfront investment. And nobody has the patience to do that with Intel.
Just quickly, Qualcomm circling, Apollo circling for a cash injection. Are you looking for more names to come into this?
I mean, it will be a buyout. So we're talking about $150 billion plus deal here, and it has to be a consortium. I can't imagine Qualcomm buying everything. If they're buying, they'll sell some assets, to begin with. And that's how I think you could conceive a deal where Qualcomm would want to own certain parts of Intel.
Interesting. Mandeep, appreciate your time. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Intel, the one to watch, going into the cash open. Coming up tomorrow, Brian Levitt of Invesco, Stuart Kaiser of Citi, Emily Rowland of John Hancock, and Jill Carey Hall of Bank of America, all welcome in the studio if they can make it through Midtown Manhattan. From New York, have a fantastic week. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
We are back, baby. The whole team here, 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, markets are waiting for signs of what's next from the Fed. After the last big rate cut, we're going to get PMI data today at 9:45.
Meanwhile, stimulus hopes rise as China announces plans for a rare briefing on the economy and cuts one of its short-term policy rates.
Plus, Intel interest. Apollo is said to have offered a multi-billion-dollar investment in the chip maker just days after rival Qualcomm reportedly floated a friendly takeover. That is friendly. Let's take a look at where markets are trading about 30 minutes until we hear those bells ring. You can see there's green on the screen behind me. Of course, we're coming off of 2 straight weeks of big gains. The S&P 500 currently up modestly, about 0.2%, a little bit more if you take a look at big tech. The NASDAQ 100 up about 0.3%. The bond market pretty calm right now. You have yields up a little bit when you take a look at that benchmark 10-year yield. We're only talking about 3 basis points, Matt, as we really wait for what the next catalyst is.
All right, speaking of treasuries, we're looking at a steepening curve here. It's disinverted, and this could be encouraged even further if we get PMIs. In Europe, they got a disappointment on PMIs. That encouraged a bull steepening, which is, correct me if I'm wrong, you're buying in the front end, and that pushes those yields down, and in any case, we'll get to that.
We will, but 16 basis points to your point of a differential is pretty interesting. Haven't seen it in a while. Some stocks to watch, though, outside of the bond market. Of course, Intel rising on news that Apollo offering up to $5 billion in an equity-like investment, according to sources. Qualcomm has also recently approached Intel about a friendly takeover, though it's unclear whether that initial discussion will lead to a deal, according to sources. You have Intel shares up pre-market about 1.5%. It was up a little more earlier. We'll keep an eye on that. Palantir also down about 1.3% pre-market, under pressure after Raymond James downgraded the stock, which enters the S&P 500 today. Also watching Dell, also entering the S&P 500, but shares unchanged, Matt.
All right. First of all, I couldn't have delivered that China headline with any less enthusiasm, but it could be a massive story if China finally unleashes the stimulus that markets have been calling for years. And then the Intel story.
Yeah.
Friday night, when this headline came out, scoop from the Wall Street Journal that Qualcomm approached them for a friendly takeover, it was huge.
It was huge. And I mean, I was gone last week. I don't know if you guys noticed, but when I left, Intel was like bottom of the barrel. Everyone was doom and gloom. I come back, the stock rallied 11% last week, and now it seems like everyone wants a piece of it, from, of course, Apollo to Qualcomm. Everyone wants Intel right now.
A little bit of competition is good here, because we had reported not only is Qualcomm taking a look here, Broadcom is not. So that Apollo competition here with a potentially multi-billion-dollar investment adds some steam to the story here, and potentially some competition in terms of who gets to invest.
It really needed some steam, some positive steam, because there was a lot of negative news surrounding Intel, clouds of it, for a couple of years. Let's dig into the situation at Intel. Bloomberg Technology co-host Ed Ludlow joins us. And Ed, you know, I talked to you on Friday night after the Qualcomm story broke. Now Apollo wants to invest possibly $5 billion. This is a business that, by the market's judgment was a failing one, right? Down 60% year to date. And now it seems like everybody wants a piece. Why?
Yeah, I mean, the Apollo development is less surprising than the Qualcomm approach was on Friday. The latest, according to sources, is that Apollo would make an equity investment in Intel. One source said it would be about $5 billion. So that's the kind of scale we're talking about. And they have some history, right? They've co-invested strategically on fab capacity in Ireland. But it kind of speaks to the idea that even though Intel has a new strategy, it announced this rethink just 1 week ago on its path forward, that strategy is still dependent on capital. And Apollo would be an interesting source of finding the cash.
Well, Ed, talk to me a little bit more about that turnaround plan. Again, I was in vacation on the mountains, but paying attention a little bit. Of course, we got more details about what Pat Gelsinger and, of course, Intel is planning to do here to reverse the ship. But talk to us more about what the path forward looks like and how an Apollo would play into that strategy.
Yeah, Intel has two parts to its business. It designs semiconductors for specific functions, chips that go into PCs, data centers, and then it also manufactures them. We talk a lot about chip makers on this program, but a lot of the names that we discuss are not actually chip makers. They design them and hand them off to a third party. For Intel, about 70% of their revenues is products, and those products are not competitive right now. They're struggling. And the foundry part of their business is where they see their potential, but it's where they have the widest losses. Sales have been declining for about 3 straight years, and losses have been widening in the business of manufacturing semiconductors, principally for their biggest customer, which is themselves, but also other third parties. To make that competitive, you need scale. And scale means putting money into new fabs. Some of that comes from the CHIPS Act. But central to Pat Gelsinger's strategy, which he calls smart capital, is money from the balance sheet, money from the public sector, and then money from what he's always called strategic investors. And Apollo fits that bill.
Well, to that end also, there's been other news around Intel, despite the conversation around potential mergers, acquisitions, divestitures, and that is their potential investment from the U.S. government for as much as $3 billion for chips for the military. That is their conversations with Amazon as well. How does this other interest and other investment around its own products really add to the story?
The mechanics of how companies access the CHIPS Act money is really important. Basically, you don't just get the money up front. You have to go out and build something and prove that the money awarded through the CHIPS Act will find a home in the end. But the defense component's interesting because Intel won a big contract for basically defense-related semiconductors that many other domestic US names have more experience in doing than Intel has. So that's a really important component. But manufacturing semiconductors is not simple. Just to build the building, let alone put the machinery inside it, is a many multi-year process. You don't just do it overnight. And as you guys know, semiconductors are largely cyclical, even if they're in sexy markets like data centers. So by the time you've built all this capacity, there's no guarantee that the demand you had the moment you put your shovel in the ground is still there once the thing's up and humming. And that's a problem for Intel because you have to keep your investor base patient. And the whole point of this rethink that Intel's going through, the attraction from Apollo for more investment, Qualcomm eyeing an acquisition, which I can't believe I'm saying out loud, it's all very interesting timing because they're going through the macro events of the industry as well.
Bloomberg technology co-host Ed Ludlow, we're looking forward to your coverage later today. We thank you so very much for your time. There's plenty of other semiconductor news, including a report that TSMC and Samsung are considering chip plants in Saudi Arabia and an agreement between the United States and India to build, UAE, to build a chip factory also in India. So between the UAE and India, we definitely have a lot of international interest in where really chips are manufactured and the global industry coming together to fuel these companies. Let's discuss all of this with Bloomberg Intelligence senior analyst Mandeep Singh. You know, it's interesting, when we talk about Intel here and the global competition, I was talking to an investor based in the U.S. the other day about whether they would invest in the Intel story, should they see these other turnaround plans, and they drew very specifically the competition with TSMC. U.S.-based investor still doesn't believe that the U.S. story can catch up fast enough. What do you think?
Yeah, I think right now, with 3 years of Pat Gelsinger trying to turn this company around, clearly, you know, it's hard to conceive Intel as a whole really recovering from, you know, the missteps they had. But the timing of, the Qualcomm news and the Apollo investment does suggest that valuation has gotten to a point where a lot of the bad news is in the stock. And when you look at the Intel, some of the parts valuation, the PC business is where they still have a dominant 70 to 75% share. The server business is where they're losing share, and foundry business is clearly where all the problems are. So from that perspective, it does make sense, that there is a floor to how low the valuation can get, and that's why you're seeing these news, in the last 7 days.
Does it matter if they have a dominant share in the PC business? Is that like having a dominant share in the printing press business? I mean, are we still going to continue to buy and use those things?
Actually, when you think about AI wave, and how transformational it's going to be, right now all the focus is on data centers and, just new types of chips in data centers. At some point, this is going to trickle down to smartphones. It's going to trickle down to PCs, and there will be a big refresh cycle. I know you've been, hearing a lot of people calling that out.
Dell.
But look, I mean, how else are you going to use AI? If it's not on your phone or your PC, it's hard to imagine, it being that big as what people make it out to be. And that's where I think right now you're going through that inventory correction in the PC market. And it's hard to imagine that, you will not see a rebound in PCs, even though the market is saturated, but there will be a big refresh cycle in PCs, and you can't just move away from Intel when it comes to PCs.
Well, I feel like you identified an existential question there, and that's how are we going to use AI? I'm not going to ask you exactly that, but I want to talk about all the different companies sniffing around Intel right now. That's really the theme of the day, of the week, is that everyone wants a piece of Intel. How badly does Intel need an investor like Apollo or a deal with Qualcomm, for example, when you think about all of the massive CapEx that they have planned to basically catch up here?
Yeah, I mean, look, when you have a negative $20 billion free cash flow, there's a lot of pressure. And that's what Intel is going through, is you can't just keep investing CapEx when, you are losing $20 billion a year, and it's reflected in their stock price. And as I said, when it comes to Qualcomm, there is a strategic alignment. Qualcomm really wants to double down on the PC side. They're big in smartphones, so Intel gives them that. I mean, on the foundry side, everyone wants to make chips here. Clearly, Intel hasn't caught up to TSMC on the process node side, but that's where you want to keep investing. And I think it's hard to do that under one umbrella. That's where splitting the company makes more sense.
We also want to get your thoughts here, not on Intel, but on Palantir, also moving this morning on the idea here that perhaps valuation has caught up to it. Of course, it has been rising, especially on the S&P index inclusion. You have written about this, but at the end of the day, you have also written that the institutional shareholder interest may not be enough to support this valuation. What does it need?
I mean, look, when a stock is trading at, 35, 40 times forward sales, again, we've seen this cycle before. In 2021, the SaaS names were trading like that. And Intel, in the case of Palantir, it's being deemed an AI winner. That's what is reflected in the case of Palantir. And, at the end of the day, they have 500, 600 customers. This is a very concentrated company. Half of the company is government customers. They've done well on the commercial side, but it's not a business where you are going to see, rapid 30, 35% growth in perpetuity. And that's where, it's hard to make a case that, they will continue to grow at the pace that they have. But, time will tell if they can execute on this valuation. The pressure is more tied to the valuation than anything else.
Did you see the video of Alex Karp running in the woods with the poles talking about the index inclusion?
I mean, look, it's a big catalyst, in terms of drawing interest. Palantir is a company that has a lot of retail interest. So, it's definitely played out well. The problem or the challenge is in meeting expectations, because when you're trading at 40 times sales, the estimates and the expectations go higher.
And Alex Karp could be also personally a problem, right? When you say, did you see the video of Alex Karp? I'm like, oh no, what did he say this time?
No, just on the index inclusion. He was in the woods. Comments are turned off on YouTube, but you can view it there. Anyway, Mandeep, great to see you, of course. That, of course, is Bloomberg Intelligence senior analyst Mandeep Singh. Meanwhile, you take a look at futures right now. Of course, we are minutes away from the opening bell. You can see the S&P 500 currently up about 0.2 pre-market. The NASDAQ 100 not too far away. The small caps are your winners right now. The Russell 2000 fighting back, currently up about 0.5%. Meanwhile, let's take a look under the hood and look at some of the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
One stock helping the S&P 500 and NASDAQ futures, Katie, is Tesla. Shares are up about 1.8%. This as we have Barclays coming out saying that they think that third quarter deliveries will be a little bit better than what the street is estimating. On the other hand, General Motors is down. This as Bernstein has cut shares to a market perform. Lots of headwinds there, according to this firm, including continued inventory pressures, a delayed EV ramp, and then international pressures as well. Turning to a big winner, one that's probably a little bit less known, but Biohaven, these shares are up 14%. The study has achieved, a study for the firm has achieved a primary endpoint against progressive brain disorder. Now, there is a 12% bearish short interest there, so I suspect a lot of this is a short squeeze against a binary outcome day and test. And then finally, if we take a look at the shares of Ulta, they are down 1.3%. TD Cowen has cut shares to a hold from a buy. They say that rising competition is an issue, plus there's a lack of execution, and valuation is full. Shonali.
Thank you, Abigail. Now, coming up, the German government does not want a UniCredit Commerzbank merger, but the Italian bank just upped its stake. That's in high interest. Next. This is Bloomberg.
People, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Now to high interest to look at what's making headlines around the world. Latest Israeli strikes on Hezbollah in southern Lebanon killed at least 100 people and injured 400 others. That's according to local authorities. Hostilities between the two sides have been escalating since pager and walkie-talkie explosions in Lebanon last week. U.S. Defense Secretary Lloyd Austin spoke to his Israeli counterpart and urged a diplomatic solution. UniCredit CEO Andrea Orcel is set to more than double the bank's stake in Commerzbank. It's the latest dramatic development on the ongoing takeover attempt. The move could escalate tensions with the German government, which has indicated that it opposes a deal. And a massive strike is threatening major East and Gulf Coast ports in the U.S. Around 45,000 dock workers are looking to walk off the job on October 1st. Talks have been at a stalemate since June. Industry officials believe a strike is inevitable. Ocean carriers and port operators have started sending out customer advisories. Shonali?
We're going to get back now to the markets with Investnet Co-Chief Investment Officer Dana Daria. And, you know, we are standing here on a day, futures are higher. We're coming off of another week of gains for the S&P 500, a little bit of exuberance seeping in after that mega cut by the Federal Reserve, and more people now baking in the chances for another 50 basis point rate cut. Is there a continued bull case for this market, Dana?
Yeah, I think bull case has to be base case at the moment because, you know, certainly the 50 basis point cut was on the upper side, surprised a lot of us, I would say, who were hedging bets a little and thinking that they'd start with 25. But, you know, we've heard Kashkari obviously talking about this, and, you know, their understanding, I think, is notwithstanding what they're saying, is that you know, the comments they made is that they might have been a little bit behind, right? That if they knew what they know now, they probably would have cut in July. So, you know, I think they're playing a little bit of catch up. They do expect another 50 by the end of the year. The market seems pretty settled on that, which is kind of nice, right? Because clarity can help with market volatility. And I think the bull case is certainly, you know, the base case, but I do expect a lot of volatility throughout the course of the rest of this year.
The bull case is the base case. Let's get a little bit more specific, though, Dana, when it comes to the actual sectors and industries you're looking at, because you have a lot of people pointing to the playbook of you buy defensives after the Fed cuts rates. You go to healthcare, you go to utilities, you go to staples, but then you have the likes of Mike Wilson from Morgan Stanley saying that actually it's time to take profits on your defensives. Where do you fall?
So it certainly depends on why you think this Fed is cutting rates, right? If you think recession, and I think everybody's kind of switched from an inflationary concern to a recessionary concern, as is done, right? Everyone does so fast, which of course, you know, but if you're worried about recession, you are moving into defensives. And, you know, the reason that the Fed is often cutting rates, especially because the Fed lags, is that they are concerned about recession. And so this leads to kind of traditional advice that says, hey, look, get to defensives. We're getting into a softer period, and the Fed is reacting to that and cutting rates. But if you believe that the economy is actually fairly strong still, that we have a ways to go before softness is really going to seep in, then you would push to areas that did very well last week, like small caps.
Does it still make sense to buy? I get, you know, that the Fed is not cutting into a recession, it's cutting into growth right now and already loose financial conditions. But does it still make sense to buy utilities or big dividend payers as rates come down?
Yeah, I mean, I think there's the case for that for sure. And when you think of dividend payers too, you end up with oftentimes lower price stocks. And I am a proponent to, you know, kind of because, you know, you have a big slug of these big Mag 7 growth stocks. You have a big slug that's invested in the AI theme, whether you picked it out or not, right? If you're invested in this market, you're there. So I think buying dividend payers and leaning a little bit toward, you know, a different play is not a bad idea because it hedges your bets and diversifies a bit.
Let's talk more about the small caps for a minute here, because that has been a fickle trade. We have seen fits and starts of investors getting into small caps and then deciding, well, wait a minute, these are still highly levered and maybe 50 basis points is not enough to get us to a place where we're comfortable with them. How far lower do rates really need to go before that leverage stops mattering?
We have a considerable amount of rate cuts in front of us. So I think small caps have a tailwind in that respect, right? 50 basis points end of this year, probably 100 next year, another 50 year after that. So what the market is pricing in now is pretty good for small caps. I think the issue with small caps is, you know, the quality concerns, right? They are more highly levered. They are more dependent on interest rate conditions because they're more dependent on capital markets in general. And what we're seeing recently with small caps as well is that it's below average in terms of profitability. So the names in the index on an average basis are not as profitable, right? And so, you know, that raises concerns. And one way you can deal with that, of course, is you can have a quality filter on your small caps. Another way, frankly, to deal with it is just to make sure you're holding a very broad-based, diversified small cap you know, index or solution or even active management strategy, because you don't really know which small caps are going to benefit. And historically, when small caps benefit a portfolio, it's oftentimes because some names get bigger, right? And picking those out ahead of time is more difficult. So I think in the small cap space, you want to go well diversified or quality.
All right, it's a great point, of course. If you just blanket buy the Russell 2000, you're going to pick up a lot of junk along the way. Dana, always great to speak with you. Our thanks to InvestNet Co-Chief Investment Officer Dana Dioria. Now coming up, Boeing ousts the head of a troubled space unit after billions of dollars in losses. That's in our Social Climbers segment up next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All right, it's time now for Social Climbers, the company's making waves this morning. And first up, General Motors announcing it will temporarily lay off 2/3 of the workers at its Fairfax assembly plant in Kansas as it prepares the facility to begin production of the next Chevrolet Bolt model, which of course the automaker will roll out a new generation of next year. Next up, Boeing is ousting the head of its troubled defense and space unit in the first major shakeup by Kelly Ortberg since he took over as CEO last month. Remember, the space business has suffered billions of dollars in setbacks, notably NASA's recent decision to send Boeing's Starliner capsule home without the astronauts it launched into space in June. Meanwhile, I take a quick check on futures. Of course, we are minutes away from the opening bell. Green on this screen. We'll see if it holds. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977
when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We have markets heading higher, even though the S&P was already closing at over 5,700 on Friday. You've got gains on S&P futures, NASDAQ futures, and Russell futures. A lot of Fed speak out today with speakers sort of sticking to the median of the dot plot, saying we could have another 50 basis points of rate cuts so far or in the rest of this year. Here you see the New York Stock Exchange. Wow, that's the Argentinian leader there ringing the bell at the New York Stock Exchange. Down on the NASDAQ marketplace, building the Futures Summit, taking the spotlight. In terms of what's going on with the major indexes as they start to get settled in, let's get over to Katie Greifeld and see where they're moving. Katie?
All right, 23 seconds into this Monday trading session. You can see, as Matt said, we do have green on the screen. Of course, the S&P 500 currently up about 0.2%. Big tech and then the small caps also rallying as well. We're coming off 2 straight weeks of gains. We are just a whisker away from those all-time highs. We'll see if we get one today. But let's take a look at the individual stock level, because we have to talk about Intel climbing after sources say that Apollo has offered to make an investment upward of $5 billion in the troubled chip maker. Of course, we got that Qualcomm news last week as well, late last week, looking at a friendly takeover here. So a lot of people lining up around Intel. Shares currently up about 2.5%, Shanali.
Elsewhere in technology, Katie, we're also keeping an eye on Palantir and Dell as they enter the S&P 500. Of course, remember, there was a big run-up heading up to this moment, but Palantir was just downgraded by Raymond James due to its high valuation. You do have Palantir shares down almost 0.5% in the market open, and Dell down about 0.3%.
All right, let's round out this conversation now with Bloomberg's Jess Menton joining us on set to my left. And we were just talking about the playbook for rate cuts in the stock market with Dana Dioria. And the reason I brought that up was because you had a great piece on the terminal with some of our Bloomberg News colleagues about basically there's no playbook here, that this time maybe it's different.
So everybody wants to harken back to prior cycles. And we did the same thing once the Federal Reserve began their hiking cycle just a few years ago, and especially when there was the bear market in 2022. So when I've been speaking with my sources, it was sort of this conundrum of what do you do? Because normally in past playbooks, it was usually utilities tended to do the best, those bond proxy-like sectors, as well as healthcare and other corners like that. And the worst were technology if you look 6 months after the cutting cycle began. But you already have sectors like utilities. I mean, that's the second best performing sector in the S&P 500 this year behind technology, but that's also an AI play. So that sector's up over 25%. So then what do you do? So you have people like Savita Subramanian over at Bank of America. She's making a call for more value, large cap type stocks, and then also large cap over small caps, even though small traditionally outperforms
This is what I was
large.
looking for.
Right.
I mean, I read your story. with interest. And okay, if it's not the defensive play, utilities obviously still do well because it's like the fact that they're cutting into growth rather than cutting into a recession. That's the difference, not the fact that they're cutting. So utilities, big dividend payers are still going to be winners. But I was reading through the story like, who should I buy? Walter Todd is saying buy financials, right? David Lefkowitz is saying he likes financials too, but also cyclicals. And then, as you mentioned, you know, big value is favored by Savita Subramanian as well.
And then also industrial type companies, because those are closely tied to the economy. And then discretionary.
Cyclicals, right?
Exactly. So you can also have that broaden out to cyclicals too, which Savita Subramanian was talking about as well when you look at that. But then also everyone wants to talk about how strong the economy still is. If you look at the Atlanta Fed GDP Now model, obviously the current quarter around 3%, but also it's very rare to see the Fed cutting when you also have corporate earnings expanding. So 8 of the last 9 cycles, usually corporate earnings for the S&P 500 were decelerating. You're seeing that earnings growth continue to grow, not just for this year. I mean, we don't have that many months left, only one more quarter after this, but the next few years, you're still seeing that S&P 500 earnings growth continuing.
18% next
yes,
year.
Exactly. Bank of America made that call.
Expected, yeah, but I mean, still, that's a huge number.
Plenty of people telling us to worry about that 18%.
But if they miss it, if it's 14%, is that still not incredible?
Well, does it justify these valuations? Let's go away from the indices for a second and talk a little bit more about single name stocks as well, because what's interesting is you are seeing analysts really catch on to single names and sectors that people worry about.
And one of those names is Keurig Dr. Pepper. And I bring it up because it's a consumer packaged good company. This is a company also when it comes to even just the industry as well. Tom Barkin, who's obviously at the Richmond Fed, he was talking about this earlier this year when they were debating on when they were going to cut rates. But this is a key metric when you're thinking about the guidance when it comes to inflation, but then also what this tells you too as far as the volume growth coming out of COVID. So the reason here is you're seeing a little bit of a boost here, up about 0.5% for this stock this morning, coming a little bit off the highs, but Citi actually upgraded the stock. And also they were talking about specifically more of the coffee volumes as well as beverage. And that's something Jen Bartashis over at Bloomberg Intelligence has talked a lot about because people want to know when they're going to the grocery store, when do you get more of those deals like buy one, get one half off, things like that. And so she was pointing out we would expect to hear more companies in the second half of the year in the consumer packaged goods space say that. And we've already seen that most recently in those earnings reports. So that's important when you do have more conviction on a company like this.
If you have to go back to work 5 days a week, I guess you need more coffee too.
I don't drink coffee. You know?
Really?
Tea. I drink a lot of tea, like 10 cups.
Obscene amounts of tea.
But do you drink Dr. Pepper? Because that's been the real story for them. The
I
kids
will say,
love Dr.
so
Pepper.
first off, no, because I don't want to get diabetes.
Right.
But if I were going to drink a super sugary sparkling beverage, it would be Dr. Pepper. It is my favorite of all the soda pops.
I feel like Katie's more of the Starbucks, right? You're the
Starbucks
train.
Starbucks.
Yeah.
It's been a rough ride, but yeah.
You know, last week when you were out, there was an amazing story. Microsoft is going to buy 2 decades worth of power from 3 Mile Island.
That is an amazing story.
Constellation Energy is going to run the plant. I mean, they run the plant.
Yeah.
And did I hear that you got an interview with the CEO?
I am, and we have a beautiful promo that I'm going to do. But I do want to go back to that theme because it really fits into what we were talking about, that utilities, okay, they're defensive categorically, but it just feels like we can't get away from that AI trade, that even the defensive names are connected to it.
And now nuclear energy is an
That's
AI
right.
trade.
Yeah, and so Constellation Energy, it's in the electric component when you are looking at the sub-industry groups in the utility sector. But actually, if you're looking at this, Morgan Stanley is actually more positive on this stock. And it has to do with what you were talking about just now, that deal with Microsoft. So if you're looking at this, and of course, this is the biggest U.S. operator of nuclear reactors here. So they raised their price target. And if you're looking at this as well, too, it's around $313. Previously, it was $233. So if you lose that implied move from where it closed on Friday, that would be actually another more than 20% gain from here for that particular stock. So that's the call that Morgan Stanley has for this. So something to keep an eye on because we were just talking about the stellar gains that utilities have been on so far this year.
Yeah, that's been the dark horse there. Jess Menton, it is always a delight to see you. That, of course, is Bloomberg's equities reporter, Jess Menton. And as Matt said, I am talking to the CEO of Constellation Energy today. That's at 12:40, maybe 12:50 p.m. Eastern. We'll keep you updated on that. Don't go anywhere, though, because coming up, Americans, as we were just talking about, riding a caffeine high. Coffee consumption has been hitting 20-year records, and that has Citi bullish on Keurig Dr. Pepper. More in Top Calls next. This is Bloomberg.
names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg Open Interest. Let's take a check on the stock market right now. Not huge moves right now on the indexes, but this isn't a market that needs huge moves. Of course, we are so close to those all-time highs. The S&P 500 up maybe 0.2%. We'll see if that's in the offing. Meanwhile, you have small caps as your big winner on the day. The Russell 2000 currently up about 0.4%. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Citi upgrading Keurig Dr. Pepper to a buy on better U.S. coffee volumes. The analyst says that the coffee business has been the main reason for the company's underperformance over the past 2 years, but says that it should now benefit from those easier comps. Next up, we have Raymond James downgrading Palantir, saying that it's no longer a buy. The analyst says that the stock's recent strong performance and its rich valuation leaves little room for error. You can see shares down marginally right now, of course, following a monster rally. And finally, we have Deutsche Bank upgrading BNY Mellon to a buy, citing stronger conviction following investor meetings with the company's CEO. The analysts over there see earnings growth in the double digits, Matt.
All right. I mean, just love to hear about European banks, especially German banks right now. That has nothing to do with it, but I wonder what Deutsche Bank is saying about Commerzbank. Let's get to the broader themes here. Stocks steady as investors await more Fed speak and PMI data due out here in just a few minutes. We did have PMI data out in Europe, and it was a disappointment with the composite falling to a contraction to a level below 50 for the first time since February. Here with more is Bloomberg macro strategist Cameron Kreis. And Cameron, we saw that lead to a bull steepening in German 2s, 10s, right? Is that the reason that we're seeing more of that here, as well as that encouraging the U.S. Treasury market?
Well, we've kind of eased back a bit in Treasuries once New York came in. But listen, it just reinforces a broader trend of curve steepening, which, thus far has been primarily bull steepening. And that just really reflects the move across most major central banks towards cutting rates, which is a sort of a classic recipe for curve steepening.
Can I just jump in here and ask you to, is there a simple way to explain bull steepening versus bear steepening to those who aren't steeped in treasuries markets and why it matters, Cameron?
I see what you did there. Yeah, so a bull, so obviously a curve steepening is when short-term interest rates go down relative to longer-term interest rates. Now, excuse me, a bull steepening comes in the context of the overall level of rates coming lower, and is typically what you associate with monetary easing. Short-term, as the Fed or other central banks cut interest rates, the policy rate is obviously a very, very short-term interest rate, and that has more of an impact, say, on the 2-year yield than the 10-year yield. A bear steepening comes when either the general level of interest rates is moving up, or more particularly the back end of the curve sees yields rising. And there, you more think of it in terms of an increased risk premium, either because of inflation or perhaps because of worries about government issuance and deficits, which is obviously still a fairly relevant topic in the U.S. in particular.
Right. Well, Matt is taking careful notes on those definitions, but what you really need to know is that the yield curve is steepening. I want to talk a little bit about the playbook here. When it comes to the bond market, we were talking about it for the stock market, what you do after this jumbo cut from the Fed. How does it play out in the bond market? Where are people placing their bets right now?
Well, I think for the most part in the steepener, because it's sort of it's almost like a heads I win, tails you lose. In the sense of, if you think sort of the two major themes in terms of monetary and fiscal policy, monetary policy, the Fed is just embarking on an easing cycle, and they have signaled through their forward guidance that it's going to be a fairly significant easing cycle. Now, whether the neutral interest rate is 2.5%, 2 3/4, 2 7/8, or 3%. The general consensus is it's a fair amount below the current level, so that would imply a fairly reasonable scope for easing, which would be supportive of sort of the bull steepener. And at the same time, the deficit is still a mess. It doesn't look like it's going to get any better, kind of no matter who gets in, at least in the near term. There's an argument to be made that after 2025, it could improve if the Trump tax cuts are not renewed, which will essentially raise personal tax rates and therefore increase revenues. But while the deficit remains so high, particularly relative to the level of economic growth, that continues to put pressure on the Treasury to issue more debt, and that remains sort of the back of mind as well. So if the economy starts picking up,
to that end, also, because we had been talking about it and you are actually seeing a little bit of movement in the bond market on top of these PMIs, you're actually seeing the U.S. global September manufacturing PMIs hit a 15-month low. You are seeing a little bit of a spike higher in the 2-year right now. You're seeing it coming in lower than expected. So what does that mean to you for the U.S., Reed?
Well, I don't think the manufacturing PMI is particularly important, given how small the small component of the economy manufacturing is. The composite PMI, which also includes the service sector, actually rose, or not rose, it came in very slightly higher than expected and broadly unchanged relative to it's very slightly below the prior reading. So I think that is more relevant and would be more of an explanatory variable as to why short-term yields are popping a little bit on the back of it, sort of not as bad as perhaps feared. And I think it's also important to remember that in the modern era, say going back to the start of the 1990s, the Fed has never started easing with financial conditions this easy. If you look at, say, the Goldman Sachs U.S. Financial Conditions Index. And that kind of raises the question of actually, are they going to have to go as far as they think they're going? Because financial conditions are pretty easy already. And if they're going to put more stimulus into the economy or remove restriction, I guess is the more apt way to characterize it, with conditions this easy, is that actually going to generate more growth and potentially more inflation than anyone is looking for at the moment?
Cameron, we have to leave it there. We thank you so much for all of your analysis. Of course, that is Cameron Price, who is all over the macro world here at Bloomberg News.
Macro man.
Macro man. Yeah, don't miss his column either. Coming up, we're going to dig into Apollo's growing interest in Intel as the chip maker struggles to capitalize on the AI movement. That's next in our Wall Street Beat. And also, Japan's prime minister is participating in a panel discussion here at Bloomberg. He is speaking with top executives from firms including BlackRock, KKR, and State Street Global Advisors, all of which have huge interest in the country, of course. You can watch this live event on your terminal at Live Go. This is Bloomberg.
In France called TKO, it's a listed company. They're very, very strong in that space, and they're now very deep partners with us. So they bring a skill set into Japan that is maybe not as strongly represented yet. And for them, the benefit is they have an immediate access to Japan into every single channel through a domestic company. So I think that that's something that I've really felt has been.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on stocks right now. About 21 minutes into the U.S. day, you can see that the S&P 500 building on that momentum that we saw the past 2 weeks, currently up about 0.2%. The NASDAQ 100 a little bit higher, up 0.3%. Meanwhile, the Russell 2000, that had been your early leader, now slipping back a little bit, but still up about 0.2% on the small cap index, Sonali.
And it's time now for the Wall Street Beat. We've been talking about the multi-billion-dollar investment that Apollo Global Management might put into Intel, according to Bloomberg sources. Remember back in June, Apollo's co-president Scott Kleinman spoke to Bloomberg's Danny Berger, anticipating more deals that they have done, like the one they've done with Intel. Take a listen.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. but in general, just the need for this type of capital is insatiable.
We're going to discuss Apollo's thinking here with Bloomberg's Liana Baker, who broke the story with her team over the weekend, leads the U.S. deals team here. And if you think about Apollo's existing relationship with Intel, with the chip industry, why is this such an interesting development in the deal talks for what could otherwise be an acquisition from another company for Intel, which is now worth more than $95 billion? Does Apollo's interests complicate any potential takeover talks?
We're trying to figure that all out to see if this Apollo offer is an alternative to Qualcomm, or could it also invest in Intel and then later Qualcomm buys Intel? We don't have those details right now, but we do know that Intel's board has to consider everything. They've said they're open to everything. So Apollo coming in with sort of a creative solution is one thing they could look at. Apollo, as you mentioned, is already tied up with Intel in their Irish plant. They've already put in billions, so they definitely are want to see Intel succeed here and not, fall by the wayside. A Qualcomm takeover of Intel is something we're still looking at, but that is a deal that could take a long time. We're hearing that an Apollo investment would be something that could be much faster and, bring that capital that Intel might need.
I sense government involvement lately with Intel announcements. I don't know if that's just my sort of deep state paranoia, or if they really are sort of helping them to get Pentagon contracts, helping them to work with Amazon, helping them to get an Apollo investment. Do you hear any of that?
Story.
Do you hear any of that?
So with the U.S. CHIPS Act and Intel expected to receive billions, I wouldn't be surprised if something like that was going on. Right now, we don't have the reporting to say, the U.S. government is behind any of this. But certainly a merger with Qualcomm would be something that the U.S. government would have to put their stamp of approval on to have sort of a U.S. solution. Without the government and antitrust and DOJ and everyone on board, this would be really a tricky deal to happen. So they definitely are monitoring this closely, but we can't say if they're,
well, focusing on the Intel part of this, of course, Intel and Apollo, they already have a relationship. You think about what happened in June when we had Intel agreeing to sell a stake in that joint venture that controls a plant in Ireland to Apollo. And Apollo also has experience in the chip-making space when you think about relationships that they have with Western Digital as well.
We've reported on the Western Digital investment. They put in, some $900 million. This would be a lot bigger. That deal was last year. Western Digital is a lot smaller than Intel. They didn't have an existing relationship with Western Digital when they did that. So this is kind of the next step. You also should know that Intel has a relationship with Brookfield. Before Apollo came on the scene, Brookfield was a partner in a plant in Ohio. So that's another name that we're kind of looking at. So far, we don't have the reporting to say Brookfield is there, but Intel's clearly open to talking to these alternative asset managers.
If Apollo and Brookfield have these existing relationships, could you look at a scenario here where you have a club deal, where you have many investors come in? Is that kind of the place we are now, where most of Wall Street is tied up in this story?
That would be a fantastic club deal if all the private equity firms could combine to take Intel private. I'm not aware of something like that happening, but I think
prop up
definitely
the valuation now, at least. They don't need to even take it private.
I think some of these partnerships with private equity could come at the right time for Intel, which, you showed in the video, you said Scott Kleinman said there's insatiable need for capital. Intel kind of has that right now, actually, so it's a good time for these alternative asset managers to come in and help.
Leanna, great having you on the program. Thanks so much for joining us. It's a fascinating story. I'm sure we'll talk a lot more with you about it in the days and weeks ahead. Bloomberg's Leanna Baker there. Let's get to the trading diary, what you need to be watching. We'll get plenty of Fed speak through the week, including Austin Goolsbee and Neil Kashkari today. Tomorrow, we get consumer confidence data to keep an eye on, followed closely by U.S. jobless claims, durable goods, and revised GDP on Thursday. And then Fed Chair Jerome Powell gives us pre-recorded remarks to the 10th annual U.S.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele. Paul Sweeney is somewhere hiking in the hills of Ireland, but no worries. Norma Linda will be joining us for the next 2 hours. This is Bloomberg Intelligence Radio. We're broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. We have a great hour lined up for you. We have CEOs talking about different parts of the economy. Gina Drosos is CEO of Signet. We'll talk about earnings as well as their outlook. Plus, the CEO of independent natural gas producer EQT, Toby Rice, will be joining us later on in the hour. How do you make money with natural gas under $3? What does that wind up meaning then as we head towards the election? Plus, Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes, is here as well. But let's get you all started, all kicked off with a business flash with John Tucker.
All right, Alex, the major stock averages mixed to little change right now, hovering around their record highs. Just before the top of the hour, we did get a snapshot, some of the global PMIs. U.S. business activity expanding at a slightly slower pace in the S&P 500, yet 8 of the 11 major industry groups higher, being led by energy as crude oil rises above $70 a barrel. Most actively traded stock, no surprise here, Intel. Apollo said to offer a multi-billion-dollar investment in Intel, and in addition to that, Qualcomm floating possibly a friendly takeover. And you want some drama? I'll give you some drama. UniCredit moving to more than double its stake in Commerce Bank. This comes just days after the German government indicated its opposition. S&P 500 right now 12 points higher. That is up 0.2%. That is at 5714. So that's what, 2 points above the record close, the Dow Jones Industrial Average. up 6 points, 42,070. That's just above the record close. And the NASDAQ 100 right now, that is 60 points higher. That is up 0.3%. As for those yields, the 2-year right now, that is up just about 3 basis points. That's at 361. And the 10-year, the benchmark, that is up close to 5 basis points. That is at 378. Let me check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Nora and Alex.
Hi, JT. How's it
Hi
going?
there.
Hello. Happy weekend.
Happy Monday.
Happy Monday
week,
plus the
right?
weekend. Yeah. Happy. Oh.
UN General
Are we
Assembly week.
happy?
John's definitely not happy. I'm just gonna put that out there. But I saw Nora walk in work this morning. So you walked.
I was hustling. I saw all the black Suburbans. That's how you know important people are here.
It's true. It's true.
They were everywhere.
They were everywhere. I was already coming in at 6:30. Were you okay coming in at 3 a.m., 2 a.m.?
I was. 57th Street, though, as they do in New York City, before they pave it, they mill the road, so it's very rough, and then it takes, a couple of months later they get around to actually paving it. And then another couple of months before they actually paint the lines.
Wait, so
goodness.
what are you stressed about? Is it the paving? Is it the lines? Or is it UNGA?
Well, it's the roadway is like driving, I don't know, in a mountain range somewhere in a South American country. So that's 57th Street today.
Excellent. Excellent. And just wait for all that traffic that's going to come up. Public transportation, that is the way to go. All right. Nora, hi. It's great to have you here for the 2 hours.
Great to be here.
Looking forward to it.
It's going to be a fun time.
So markets on the whole are doing not that much. I'm also sort of like, well, what's the catalyst now after we got past the Fed? We have to wait for jobs day. Individually, though, there's still some individual stocks that are interesting, and let's get more on that with Jess Menton. She joins us now from Bloomberg News. All right, Jess, what stocks are you watching today?
Yeah, so we only have 1 week left in this quarter. So you have the S&P 500 up about 5%, whereas the NASDAQ 100 up just about 0.8%. So the end of the quarter will be next Monday on September 30th. So underneath the hood, I'm actually looking at consumer packaged good companies because they're a good tell on the economy, the direction of inflation. It's something that Tom Barkin has said he watches closely when it comes to price to mix volumes here. So Keurig, KDP is the ticker symbol. It gave up some of its earlier gains, but still up about 0.7%. You want to compare that to year to date, though, up about 13%, so still underperforming the broader S&P 500. But what's important here is Citi actually raised its price target on the stock, and some of this had to do with coffee volumes as well as beverage growth that it's seeing. So right now, its price target is up to $43, and it used to be $36 a share. So that would imply about a 15% increase from where this stock actually closed on Friday. So this is an important gauge when you're thinking about the direction. And also, Jen Partashis over at Bloomberg Intelligence talks a lot about when it comes to people looking about if you're at the grocery store and you're wondering you can get something, buy one, get one 50% off, different deals like that, as a lot of those consumer packaged good companies, and not just if you're thinking about Keurig Dr. Pepper, but say like Conagra or Mondelez, different companies like that that have been dealing with it. So a lot of those companies in their most recent earnings reports have talked about how that's more of a strategy that they've been rolling out. So you're starting to see a lot of the sell side take notice of that. So that is why you are seeing that stock in particular supported here. If you look overall, SPAC is the group where you can track more broadly the consumer packaged good companies in the S&P 500 today, though. So not moving a ton, but if you look year to date, that's up about 5%, but still obviously underperforming the S&P 500.
And I mean, I'm looking at ticker KDP as we're talking about it here, and it seems like Wall Street is really trying to figure out, I mean, we've got 11 buys, 9 holds, and 1 sell, so really interesting.
Yeah, another one I'm taking a look at too is, and I know this is one of Alex's favorites because she likes to look at utilities.
Yes, I do.
Exactly. And especially because that's been more of an AI play this year. And also I wanted to point out the utility sector is the second best performing sector in the S&P 500 year to date, up more than 25% behind none other than technology. But a lot of that has to do with those companies that are tied to the data center type businesses. When it comes to Constellation Energy, it's actually in the utilities electric there when it comes to that sub-industry group here. But what's important, this is another one we're seeing an upgrade from, and more specifically, it's actually Morgan Stanley that upped their target when you're looking at this. And it actually came off the back of the news at the end of last week. Actually, Constellation Energy announced how it was going to restart its 3 Mile Island nuclear plant and sell the power to Microsoft for AI. So that is why if you are looking at Constellation Energy, it's up about 4.5% right now. If you look at this on of course, for its best day since Friday because it's been on a tear here. But if you look year to date, CEG is the ticker symbol for Constellation Energy. It's up 128% here. And a lot of the conundrum we were thinking about, I wrote a story with some of my colleagues on the equities team that we ran yesterday in the terminal, is what's the playbook for traders as far as how they position coming into the Fed now finally cutting rates. And usually utilities would be among the best performers 6 months after a rate cut cycle starts. Tech would be the worst, but this has already been front loaded because of the AI play this year. So it's kind of the conundrum of, is a lot of that already priced in for utilities? Also, you're seeing earnings growth expanding right now, as well as GDP growth is still very strong. So usually 8 of the last 9 cycles, earnings growth was decelerating, not expanding. So it's a little bit of a different when you're looking at what's happening in this here. But Constellation Energy, actually it's target $313 at Morgan Stanley now. So it actually would imply a more than 20% gain from its Friday close.
So a couple thoughts on that. One, like a utility versus a power provider can sometimes be a little different when you're looking at the overall index for that. But also, it's the 3rd best performing stock in the S&P so far this year. The first is Vistra, which is also a power company. Second is NVIDIA, duh. And the 3rd is Constellation Energy. And then the 5th is GE Vernova. And that's like all the same kind of story about these power providers. What are you smirking about, John Tucker?
I'm just
He's smirking.
You're just smirking. Basking in the glow of your energy knowledge.
I'm glad that you brought up
he was totally smirking.
Right. I'm glad you brought up Vistra, though, because they also got an upgrade from Morgan Stanley as well. So they moved their price target to $132, was previously $110. Actually, Vistra FST is a ticker symbol, up 193% year to date.
All right, Jess, we appreciate you. Thank you very much. Jess Menton of Bloomberg News. She has and she's a great piece out on the terminal, kind of what is the next catalyst after the Fed rate cuts. And I'm kind of wondering about that too. Like we started it, now what? We have to wait till October 4th.
We gotta
at the
see.
End of the day. We gotta see. REITs, are you looking at REITs?
I'm always looking at REITs. It's funny when you've mentioned utilities as being one of the outperformers coming out of these cycles. Same with real estate. When we're looking at REITs, they tend to outperform coming out of these rate cut cycles. And what we've seen historically, that tends to be the case. So, I mean, it's interesting. Some people are saying, are some of these things priced in for REITs? But then you've got a lot of Wall Street that's also saying they could be the big winners moving forward.
Yeah. And in case you didn't know, Norma Linda also covers REITs.
That's my jam.
Energy is to me as REITs is to Norma Linda. All right.
Synonymous.
We get a bunch of CEO interviews the next 2 hours. And I say a bunch because it's nice to get perspective kind of on the ground on where the growth is, where the worry spots are, how hiring is, what inflation looks like. So let's kick it off now with Signet Jewelers. So they had earnings on the 12th, and they did really well. They reported adjusted earnings and comparable sales for the second quarter that topped analyst expectations. The stock since then is up over 11%. Management said in the earnings statement that comp sales are positive so far in the 3rd quarter. Some of the analysts are also saying, look, this was a better than feared quarter, especially when you look at the reiterated annual guidance. So we wanted to get an update from the CEO. Jenna Grossos is CEO of Signet, joining us now from Seattle. Jenna, walk us through sort of the highlights, like what you think that it really impressed investors, and then we can go from there.
Sure. Well, good morning. Great to be with you. Our team delivered a sequential improvement in same-store sales. It was the 5th quarter in a row that we've seen a sequential improvement. As you said, comp sales have been positive in Q3 to date. That's encouraging because in the jewelry category, and especially engagements, COVID is actually just ending. So while for a lot of businesses, COVID was in 2020, people tend to get engaged about 3 years after they meet, and people weren't meeting during lockdown in 2020. So we saw a 25% drop in the average number of people getting engaged in 2023, and that's been slowly coming back in 2024, but we saw that turn positive as we've entered the 3rd quarter, so that was encouraging.
I wanted to know, of course, a lot of consumer companies have talked about how shoppers are watching their spending carefully. They're being very nitpicky. Is that something that you all have noticed at all? What does that look like for your business?
Yes, I think we've seen a cautious customer for most of this calendar year. An example of that is that we see customers coming to our websites 15% more often before they make a purchase than we did a year ago. So people are being careful in an environment like this. But when it comes to getting engaged, they might delay a little bit, just make sure they're getting the right value, which given our scale, we feel like we can very often offer, but they're still deciding to get engaged. And we expect that to pick up as we go through peak engagement season, which is during the holidays.
Hey, Jenna, it's John Tucker. Can I ask a quick question? I can see the price of gold, by the way, is at a record. How do you track diamonds? Because that's essentially a cartel that controls the supply and I guess the pricing there, right? How does that work?
No, diamonds trade just like gold does. They're a commodity. Many, many years ago, it was more of a monopoly situation, but that hasn't been true for a couple of decades now. There are multiple miners that mine diamonds around the world. Signet is one of only 5 retailers in the world that are vertically integrated and actually buy diamonds directly from the miners. We own our own cutting and polishing facility in Botswana, so we have a really good, I would say, a vertically integrated eye into what diamonds should cost, what metals should cost, how much it should cost to cut and polish a stone. And that's how we're able to bring great value to our customers.
Now, how do you control the sourcing or know where it comes from?
So that's really one of the places where Signet has shined and been a leader in the industry. Responsible sourcing is very important to our customers and to our company. And I, and to my 20-something children, I should add. And so we are pristine. We can guarantee to all of our customers, we have what's called the Signet Promise, that we are confident that all of the metals and all of the gemstones, including diamonds, that we source are conflict-free and produced in a way that, that they would feel good about. So we trace that back to the origin of where the diamonds or where the metals come from, so we can be confident.
There's also the lab-grown diamond phenomenon. And when I was doing, packages on diamonds 15 years ago, that was like really taboo. Now I hear of younger people, and this is what they do. They want to save a little money, but they still want it to look pretty. What kind of market do you know is evolving here, and kind of what the pricing is and what the demand is?
Yeah, so lab-created diamonds have been broadly available in jewelry since 2019, so about 5 years now. Of course, they've been available for a long time in drill bits and things like that needed a hard substance to be part of it. But in jewelry, about 5 years. Every year since they've been in the market, the price has fallen about 15 to 30% actually. So they haven't really maintained their value over time, and that's because they're made in a machine in about 3 weeks, whereas a natural diamond is precious. It's made in the earth over 1 billion years, and so they're chemically the same but quite different. And what we've seen is that consumers, if they are on a tight budget and want to get a bigger stone, lab created can be a great choice for them in an engagement ring, but it's particularly a great choice in fashion jewelry, where maybe it's not quite as sentimental a piece. That's where we really see lab created as having a bigger potential over the long term.
So just to tell John Tucker. So a fashion jewelry is like, here's my super cool ring that I'm doing with my evening gown.
Everyone look at it. It's cute, right?
It's really big. Maybe it has a good shape that's kind of interesting, but I didn't have to break my bank for it.
Yes. Now, is there some plan by you guys to try to get people to get married?
By you guys, you mean us, or do you?
No, not you
mean
two.
Jenna?
Some evil plan where you pipe in romantic music to all your. There's got to be, right?
A ploy.
A ploy.
No, we don't plan, but I will say that we have a lot of consumer insight around that. Several years ago, we started tracking the milestones that couples typically go through between when they meet and when they get engaged. So, for example, they typically go to a movie or a concert before they say, I love you, or move in together, or meet the parents, or things like that. And so we, with our partners at Google and Meta, have identified 45 trackable signs or milestones that couples typically go through. Once they've crossed over 26, they are statistically significantly more likely to get engaged in the next 12 months.
The more you know.
One of the
when they have their
things,
first fight.
I'm learning a lot.
Yeah.
This might be speaking right to Nora.
Right, as I'm thinking about the future.
It's super interesting, and that's one of the things we said in our second quarter call is that there's a 900 basis point increase, or 20% more couples that crossed over that milestone in the second quarter this year versus the second quarter last year. So we really are seeing this ramp back up to a normalized level of engagements.
Aw, so happy on 10 o'clock on a Monday. All right, thanks so much, Jenna Drossos. We really appreciate it. CEO of Signet. I love that there's like an index that you can track that shows like dating and engagement.
We have a completely different take, you and I, on this subject.
Well, because we're like old married people, like not to each other, but they're different layers here. Nora's young. We don't want to ruin her of this experience. All right, coming up, we're going to talk to Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Manager over at Federated Hermes. Plus, the headline that really caught my eye is Apollo looking to make a multi-billion-dollar Intel investment. We're going to talk to Liana Baker of Bloomberg on that story. This is Bloomberg.
Bringing together enough talent in one organization is really hard to do. And if you're working on a problem that, may be modestly successful, it's kind of easy to get the first few people to join. You can give them a lot of equity. But then it gets really hard. Why is employee 20 going to join? Why does this matter to the world? Why should someone work on your startup versus any of the other things they could do? And picking something that matters if you're successful is a great way to do that. And so I think it's really important to think about when you're starting the company, how is this going to evolve into a vision that a lot of people want to help with, that a lot of people want to be associated with? Because I think getting talent and getting mind share is really hard in the current environment, and people are interested in startups that matter. Another thing that we've noticed among our best founders again and again and again is that they have a confident and definite view of the future. They may be wrong, and so we say it's good to be confident and flexible, but this idea that you are confident and definite, this is what I think is going to happen, or this is what is going to happen, and being relatively sure of that, having courage of your convictions, being a clear leader, saying we're going to do this, and that's why, even in the face of a lot of doubt, that seems to really correlate with success. And this comes back to having an ambitious vision, but the entire startup ecosystem is best set up to support companies that have a low chance of success, but are huge if they work. And I think going for something that is huge if it works will attract the best people. I'm not going to talk too much about the team. There are a lot of obvious things I could say that have been said many times by many people about, you need smart people who want to work really hard and who communicate well. These are all really true. But I'd like to mention a few non-obvious things that we've noticed that we don't hear people say as much about the team you need to assemble. Vinod Khosla says that the team you build is the company you build, and I really think that's true. I've still met only a handful of founders, I think, that spend enough time on recruiting, like Mark Zuckerberg is famously one of them. But building a great team, I think, other than picking the right market and building a great product, is the most important thing you do. All founders go through a transition, all successful founders, where you switch from building a product to building a company, and building a company really is about the team. So you need optimists. The whole world will be telling you why you're going to fail as a startup. If you don't have that internal fire of belief, if you don't have people who say, you know what, we are going to do this, and it doesn't matter what the haters say, we're going to figure this out. And there is, this problem, it must be solvable. If you don't have the spirit of optimism on the team, it's very hard to succeed when the world continues to punch you in the face. You need at least some idea generators. There are a handful of people in any company that has gone on to be really successful that I've been able to work with, who are just really good at coming up with lots of ideas. You don't want too many of these people because that's more ideas than a company can follow through on. But having some people within a company that are just constantly throwing out new ideas, most of which will be bad, turns out to be super important to have on the team.
Right now, 42,132 on the index. The S&P 500, 18 points higher. That's up 0.3%. 57.20 right now. Keeps that up again. Record closes for both of those indexes. The Nasdaq Composite right now, that's up 53 points. That is up 0.3%. That still has a ways to go before retracing its record. As far as yields, we did get those PMIs showing some slowing in the major part of the U.S. economy. 2-year yield right now, 2 basis points higher. That's at 361. The 10-year yield, that is up 4 basis points. That is at 378. And most actively traded stock today, that crown goes to Intel. Of course, Intel in the news. Our sources say Apollo Global Management, they want to make an investment in the company. The alternative asset manager indicating in recent days it will be willing to make an equity-like investment of as much as $5 billion in Intel. This development also comes as Qualcomm is floating a friendly takeover of Intel. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Nora and Alex.
All right, thanks so much, John Tucker. I'm Alex Steele alongside Norma Linda. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. Here's some interesting points. Chicago Fed President Austin Goolsbee is speaking in a Q&A event right now, and he's saying the overall economy has some warning signs and some strength, and he thinks that rates are way above where anyone thinks neutral is. Interesting, because a lot of the conversation last week was how neutral may be actually higher than most expect. Let's get more with Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes, joining us. Hey, Phil, good to see you. What do you make of these comments?
Thanks for having me back, Ellen.
You bet. Like, we start to get the drip of the Fed speak, right? So Goolsbee talking about that rates are way above where neutral is. You have Kashkari saying he backs another 0.5 percentage point of interest rate reductions this year. Do you trade off of this right now?
No, because the market's, sitting at all-time record highs here. You're trading at about 23 times this year's earnings. Yet the appropriate price-earnings ratio, given where Treasury yields are, should probably be somewhere around 18 times earnings. So you've got a valuation delta there. Let's call it 20% to keep the math easy. So I'm not chasing stocks here. Given the fact that some folks think that neutral should be lower. Frankly, we agree with that. Neutral probably should be down around 3%. We're going to get there over the course of the next 2 years. The question here, I think, is more pace and magnitude in terms of how quickly, how aggressively we get to 3%, and that's the issue to be debated.
So we just got that jumbo rate cut last week. How are you all thinking about the cadence through the end of this year?
So we were in the quarter point camp, for a number of reasons, based upon what's going on with inflation, what's going on with the labor market, and importantly, what's going on with this election. Historically, the Fed does not like to put its thumb on the scale and tries to avoid the appearance of impropriety during presidential election years. Now, given the tone of the data, in our view, it was absolutely appropriate for the Fed to cut interest rates, but we would have opted for a more conservative quarter point cut. So if we got the half point cut, and now you've got some Fed speakers saying, well, maybe we should do another half in November, or do another half in December. We just think that may be a little too quick. Just take a look at, we've got a key inflation reading coming up this coming Friday. The personal consumption expenditure index is actually expected to go up from 2.6% to 2.7%. And then we just got the survey week data for the initial weekly claims hit a 5-month low at 219,000. That tells us that the non-farm payroll report that we're going to see in the next couple of weeks is probably going to be really strong relative to expectations. So you put all that together, and in our view, a more conservative quarter point cut last week probably would have been appropriate.
All right, just some breaking news for you. Germany now saying it does not support a takeover of Commerce Bank. And this it comes as UniCredit has quietly built a large stake in Commerce Bank. Really interesting cross-border merger here, potentially. Barclays helped UniCredit build this. German government announcing it does not support a takeover of Commerce Bank. So anyway, Commerce Bank stock is halted for volatility over on the DAX. We'll keep you updated on any headlines that cross on that. All right, Phil, so is this the time for small caps, or is this not yet the time for small caps?
No, it is the time for small caps. We have been expecting that this rally would broaden out, that we'd see the powerful performance of the Mag 7s fade, and we'd see small cap and value and international stocks sort of fill the void and play catch up. So the fact that those categories have done better here the last couple of months, that's a trend that we think has legs.
Have stocks already priced in all the rate cuts that we expect, or do we have further to go when we're thinking about these all-time highs?
No, I agree with you. I think stocks are ahead of themselves. You look at where we were at the beginning of August, the stock market has rallied in round numbers about 12% over the last 5 or 6 weeks or so, anticipating two things. Number one, a very dovish keynote speech by Powell at Jackson Hole, check that box, and then that we would start the rate cutting cycle at the September FOMC meeting, and there were some folks that thought we'd get a more aggressive 50 basis point cut. Check that box. So stocks are up 12% here, in the space of about 6 weeks' time. So in our view, sort of buy the rumor, sell the news. The market has priced in all of the good news on interest rates. We'd be a little nervous here, a little cautious, given where valuations are on stocks and given where treasuries are. Again, that delta in terms of what's an appropriate valuation would suggest that you've got a gap there of about 20%, which suggests that you could see a consolidation here. Let's call it something in the 8 to 12% neighborhood over the course of the next couple of months going into the election, if there's any missteps along the way, either from a central bank standpoint, an election standpoint, or just general market sentiment.
All right, Phil, we appreciate it. Thanks so much. Looking forward to all the data and the catalysts going forward. Phil Orlando joining us at Federated Hermes. Good to get your take on this Monday. Always good to see you. One stock on the move is definitely Intel, up over 3%. It had a big gap higher here on the end of close on Friday on the rumors that maybe Qualcomm was looking at a possible deal for Intel. Then this morning, we learned that Apollo was offered to have made a multi-billion-dollar investment in the company as well. We wanted to get more on this with Liana Baker, Bloomberg News Managing Director of the deal team. She joins us here in studio. Liana, talk us through the Apollo part. What does that look like in your reporting?
Sure. So this is a potential investment. Apollo has made this offer to Intel. It's unclear if Intel is going to take them up on this offer, although Apollo is already a partner to Intel. They have a joint venture with them for their Irish plant, which was a really big project. So we're waiting to see how Intel decides to proceed. You mentioned there is an approach that came from Qualcomm late last week. So Intel has a lot to think about. Its board is meeting to decide which way to go. This Apollo investment could be an alternative potentially to the Qualcomm merger, or it could be something that happens before. Any deal with Qualcomm would take a long time, according to analysts, just due to all the regulatory bodies around the world that would have to bless this deal.
Now, was this expected in your reporting? Were there any whispers about this prior to this?
So we've been chasing for a long time what Intel is going to do. Since their disastrous earnings report over the summer, they've kind of put themselves in play. At Bloomberg, we were the first to report that the company was thinking about M&A options, about a potential split. And then you might remember that late last week, Pat Gelsinger put out a statement kind of laying out what would happen. We are watching to see what happens with the foundry business. Intel Foundries is something that Intel has spent a lot of money on over the years, and it's not making money. It doesn't have that many customers, and that is sort of sinking the company right now, even though it's kind of the long-term future play that the management has laid out for Intel.
What is in it for Apollo? Like, I know you said that they have a joint venture, but like, why?
So Apollo is a turnaround specialist. They love complicated situations, putting money to work where maybe other pockets of Wall Street doesn't go. This is a perfect example. They've already invested in Intel. Intel clearly needs some confidence capital. They need someone on Wall Street to say, I believe in the future of this company under Pat Gelsinger. This is why, because the stock slide has been really remarkable to even be at the point where it could be considered a takeover target for Qualcomm, one of their competitors.
So where does Wall Street think that they should go? Qualcomm or Apollo?
We don't know at this point, and there could also be other suitors or analysts are saying. We reported over the weekend that Broadcom, which some people have speculated could be interested, that they are currently not evaluating an offer for Intel. So right now Broadcom's on the sidelines. Could that still change? We'll keep an eye on it. But Intel has a lot of options to consider. It's going to be an interesting few weeks to see where things go.
Hey, can I ask a quick question? How does this impact the CHIPS Act, the investment from the Biden administration? Does that change at all in any of these scenarios?
It's all related because the U.S. government has a long-term bet on Intel as a manufacturer that's in the U.S. of chips, which are so critical. So the U.S. government is watching this all really closely. They want Intel to survive, whether that's with Qualcomm, whether that's with a capital infusion from Apollo. So they want to be part of the solution since Intel stands to gain a lot of cash from the government.
They want them to combine so they would tell Justice and the other regulators, hands off this one?
That would be interesting, wouldn't it?
Right. And it sounds like a conspiracy theory, but you have to understand that any deal that Intel does would need the blessing from the government. So sure, could the U.S. government tap Qualcomm on the shoulder and say, hey, do a solid for us and make an offer? I have no idea, but there's all these different theories that people are saying, and it's not that crazy to think people in D.C. might know more about this deal than we know right here.
Right. What's the most interesting thing that you found through your reporting?
I just love semiconductors. It's always interesting, and just to see an American icon like Intel faced with these prospects, and we're talking, this could be the largest tech deal of all time if Intel is somehow sold. So it's just amazing to be following this situation because I've been reporting on semis for over a decade, and you never know how this is going to go.
Well, also just how fast this all deteriorated. Like, I've read so many stories of sort of the decline in Intel and how fast it came on, and then we're talking about this moment where like Qualcomm might need to step in, Apollo might need to step in, the government might need to step in a particular fashion. That to me is really striking.
Is it also striking to you how quickly NVIDIA kind of caught everyone's imagination? And so it's just semiconductors, it's cyclical, it depends on trends and AI, so it's so fast moving, and it's just been a spectacular industry to follow.
Yeah. All right, Liana, thanks a lot. Great reporting. Really appreciate it, Liana Baker, Bloomberg News managing editor for the Deal Team, joining us on that. All right, coming up, natural gas prices, $2.58 MMBTU. That's what the cool kids say. What do you do if you are the CEO of one of the largest independent natural gas companies in the U.S.? We'll talk to Toby Rice, CEO of EQT. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stock indexes hanging near their all-time highs at this point. Intel, most active stock, that is up close to 4%. S&P 500, 11 points higher. That is up 0.2%. 57.13 on the index. The Dow Jones Industrial Average, 24 points higher, 42,087, another record there. The NASDAQ 100, that has a ways to go, 48 points higher right now. That is up 0.25%. Ed Yardeni at Yardeni Research, talked to him earlier today. He's counting on political gridlock to boost stocks further. He says the November election will have a major impact on the markets.
If we just get a complete and total sweep by the Democrats or Republicans, I think both of them are promoting some pretty radical fiscal policies that would not be good for the market because it would probably be inflationary.
Two-year yield right now 2 basis points higher. That's at 361. The 10-year is 4 basis points higher. That is at 378. And the drama deepens. The German government says it doesn't support a takeover of Commerce Bank. This comes after Unicredit quietly raised its stake to around 21%. The economy possibly facing a jolt that threatens the kind of supply chain disruption and consumer discontent that we saw during the pandemic. Gulf Coast and major eastern port workers threatening to strike October 1st. So, another thing to look forward to. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Nora and Alex.
So does that mean when you're on the beach and you're looking at the tanker tracker app thing, it won't work then?
No, well, I can see all those tankers stacked up as before New York Harbor. They're out there waiting for the what are called the Sandy Hook pilots to bring them through the port underneath the Verrazano Bridge. Yeah, during the pandemic, it was incredible, the number of ships out there. And the same ones out there for weeks and weeks on end. In fact, there were locals who would get in their boats sympathetic to the crews and bring them supplies and stuff like that.
Awesome.
Was very cool.
We're going to have you on the ground reporting from that. I think that's what's going to happen. I'm Alex Steele, alongside Norma Linda. Paul Sweeney is in Ireland drinking a pint right now. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. So natural gas prices are at $2.57 MMBTU. It's much better than we were before. We were under $2 MMBTU. But still, considering the amount of demand globally that we need, that price is a little bit low. So we wanted to check in with the largest independent natural gas producer right here in the United States. They have world-class assets in Appalachian Basin, and that is Toby Rice, CEO of natural gas producer EQT. He joins us in studio. Hey, Toby, good to see you.
Good morning.
So do you like prices at $2.58?
Well, we are unique in the sense that our company actually can generate free cash flow at a price as low as $2. But that is not the case for the other producers in the United States. Our view is that the marginal producer in the U.S. requires about $3.50 to justify activity levels and putting rigs up in the air.
So when you look at prices, say, then under 3, or actually under 2, where do you sort of like just say we're just going to drill them, not complete them, and hang tight, and then when you kind of release it, and what does your inventory right now look like?
So right now, short-term, people are looking at curtailments, and you have about 2 BCF a day of natural gas that's currently curtailed. This is as simple as just operators shutting in the chokes. That production could come back, and you'll see that pressuring prices up until about $3 range. But then after that, there's some short cycle activity that would come back, requires about $3.50. And again, that's sort of the price that you'll see with activity levels. So these shorter prices we're seeing right now are going to ultimately influence activity levels that are set as part of the 2025 budget planning, which will influence supply in the future, and we think is going to be pretty constructive towards the second half of 2025, where more LNG demand picks up and some of these activity reductions will start hitting the front lines.
Well, let's talk a little bit about AI. Natural gas is not, of course, at top of mind as an artificial intelligence trade, but some people are saying that rising power demand for more natural gas demand. Are you drilling to meet that demand at all? How would you all boost production?
Well, natural gas, about a third of it is used for power generation, so it is a very important dynamic to study and look at. EQT has an asset called Mountain Valley Pipeline, which is a very contested pipeline. Fortunately, that was put in service this summer. That's going to send about 2 BCF a day of natural gas down to the southeastern markets. And we just announced some deals, one of the largest physical supply deals with 2 very large utilities in that market to deliver up to 1.2 BCF a day of natural gas. Now, where is that natural gas going? Sure, it's going to help keep people's homes warm in the wintertime, but a large portion of that is going to power gen, and it's going to be replacing coal facilities. That would be enough natural gas to power about 8 gigawatts of power.
Now, one of the biggest problems in this whole scenario is how you move the stuff, and that's a pipeline issue, and that's an infrastructure issue. Where are those conversations now? In that, are we going to have data centers built near where you guys pump natural gas, or are we actually going to be able to get the pipelines in the ground to move it to where those data centers can be built?
Well, it always makes sense if you're an energy-intensive business to build your facilities close to where the energy is, and that would put Appalachia as a really great place to be. But, you know, just to step back at a very high level, what's happened in the United States over the last 15 years, and it really understands the natural gas markets. Since 2010, demand has grown 50% for natural gas. But during that period of time, natural gas infrastructure, pipelines, has only grown 25%. And most importantly, natural gas storage infrastructure has only grown 12%. What does that mean? That means we haven't built enough pipelines to keep up with demand, and our current pipeline system is maxed out. You're going to continue to see big disconnects between markets, like we're going to be selling our natural gas for $4 in Appalachia, and people in Boston and New York are going to be paying $10 to $20 for that natural gas. But the storage infrastructure is probably the most important dynamic. Simply put, natural gas storage is no longer sufficient to balance supply and demand. And what that means is that price is going to balance supply and demand. And so we would describe the natural gas markets going forward as being very volatile. And we think pricing could be as low as $2 that you see now, and you see there's sort of a natural floor where operators will actually curtail production volumes. But we also think gas prices could be significantly higher than that. And the last structural piece of the puzzle has been the massive retirement of coal. Has traditionally been a replacement fuel when gas prices got high. And gas to coal switching would occur when prices would run in that, call it $3 to $5 range. Well, with coal gone, the lid on gas prices is significantly muted, and that means prices could run up closer to the $8 to $9 range. Those are the prices you saw in 2022, and that is the price where industrial demand will start shutting off. That's not a great place to be. The solution is get more infrastructure built in this country, both pipelines and storage infrastructure. And if you have the opportunity, build your manufacturing in Appalachia.
Interesting. I mean, we're right around the corner from the winter season. That's when I cry. It's going to be cold. Is the market oversupplied this winter?
Right now, we have about 300 BCF of extra gas in storage. It's about 8% higher than normal.
Billion cubic feet.
Yeah, and for perspective, the U.S. market is about 100 BCF a day. That's what the current supply is today. But this can be corrected very quickly in a winter period where natural gas demand in this country goes north of 120 BCF a day. So right now, storage is a little bit oversupplied, but that goes away with just a normal winter. And when you think about the fact that we don't have the necessary pipeline infrastructure to deliver natural gas in that just-in-time scenario, it's going to put further pressure on prices, hence, you know, a lot of volatility towards the upside.
Here we don't have that much time, but you have a Southwestern and Chesapeake maybe merging up here. Where would you be looking to add M&A? Is it going to be pipelines or is it going to be producers?
So we just completed our transformation at EQT over the last 5 years, Alex, since taking over. We've been very purposely designing this business to be the energy company of the future. For us, that means we wanted to create a business with a low cost structure in a commodity business. That really is your only moat. We are really excited to say that EQT over the last 5 years has cut its costs by 30%. We now are looking at a $2 cost structure. We've increased our productive capacity by 50% over that period of time, and show me the money to our investors. We've increased our free cash flow per share by 2 times.
Huge, yeah.
So we've doubled that over. So we're in a great place right now, and we're just going to continue harvesting the success of the transactions we've done in the past.
All right, Toby, really good to catch up with you. It's been too long. Toby Rice, a CEO of EQT, joining us. This is Bloomberg Intelligence. Happy Monday.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday. I'm Alex Steele alongside Norma Linda. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economic, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. Well, earlier today, we were talking to Just Mention about some of the outperformers within the market, and one of them is Constellation Energy. It is the third best performing stock within the S&P so far this year. It's basically a nuclear power provider. Now, the deal that we got on Friday was that Microsoft teamed up with Constellation Energy to restart their nuclear project on 3 Mile Island. It'll be about $1.6 billion. And we wanted to get more on this with Rob Barnett, Senior Energy and Commodities Analyst. He joins us now. Hey, Rob, was this a surprise to you?
Well, I don't think the idea of Microsoft chasing energy or electrons was a surprise. The idea that data centers and all the things we're doing with AI require a lot of energy, that's an emergent theme that we've been working on for a while. The nuclear angle is a bit of an interesting anecdote for the business. These data centers just consume a ton of power, and this just really signals about how much energy these kind of systems are using. And by 2030, we think that data center energy use or power use could grow something like 4x or even up to 10x within just a handful of years. So we think things are really growing fast, and this is just the latest signpost that this is a real trend that's occurring out there in the world.
Talk to me about the idea of having one customer demand so much power for data centers that it requires an entire power plant.
Yeah, I mean, when we first started thinking about this problem, I was a bit skeptical because I had seen some of the sort of titans of the tech industry talk about this idea that you need a breakthrough in energy, or that data centers could consume something like 20-25% of U.S. power demand. And I thought, well, these people have created these really powerful tools that are creative and interesting, but they just don't understand the energy world. But when we went and started trying to tackle the problem, deconstruct it, and do a bottom-up analysis, if the tech industry really is going to build all of the systems that they say they're going to, the numbers or the ballpark is roughly accurate, that these data centers are really going to consume a lot of power. We did one of the things we did as part of our exercise is we just said, look, how many NVIDIA Blackwell GPUs are going to get sold over the next 12 months? And bottom up, we determined that based on all the chips they're going to sell, it could add something like 40 terawatt hours of power use to the grid, just based on the first year of sales. A nuclear power plant maybe does 6-7 terawatt hours. So this one nuclear power plant that Microsoft cut a deal with Constellation for can't even power all the NVIDIA chips that we think are going to get sold over the next 12 months. So these are staggering numbers to think through. They're really big, and energy is a big constraint potentially for the rollout of AI.
So what are the potential headwinds? I mean, I think that it sounds like this is a really bullish take everyone has right now, but what should people be watching out for?
Well, I think the industry is going to have to adapt and get creative. In many markets around the U.S., if you roll up to your local utility and ask to get connected to the grid, you might get laughed at, particularly if it's a big data center project. We haven't done a gigawatt data center yet, but potentially some of that size might be in the offing. And I think it's just going to take a little bit of time to get everything connected. I think you are seeing a preference in some parts of the industry moving to places like ERCOT, Texas, where the regulatory system allows you to perhaps move a little bit more quickly to get new power plants, new transmission, things like that online versus a PJM market. But I think the tech industry wants the power, and they're going out to anyone who can potentially give it to them, including Constellation in this anecdote, and saying, look, we'll pay to get it done. And I think the tech industry is also very interested in reliable power. They want the data centers to be available 365 days a year, 24/7, and nuclear provides that kind of potential. And so there is an interesting case here. Unfortunately, there aren't too many mothballed nuclear power plants just sitting around ready for this kind of thing to be done with. But maybe we'll see a few more sort of anecdotes around nuclear. But to build new nuclear is kind of, you got to think in decade timescales, which is really beyond the speed with which some of these tech companies want to move.
So, Rob, another solution people talk about are SMRs, small modular reactors. So they're is that really something that can be scaled up economically for these hyperscalers?
Well, economically, let's see. We just don't have the data yet. I mean, it's potential that these new type of nuclear power plants could really be built quickly and built economically, but we haven't really started rolling them out yet. I mean, of course, we effectively use SMRs on nuclear submarines, aircraft carriers, things like that, but we really haven't rolled them out for civilian use, and there are a number of companies trying to do that now. And I think it's the jury's out on whether the business model will work or not. But one of the great things about, say, the solar industry is they're made on an assembly line. We just crank them out.
Exactly.
The old school nuclear power plants, every single one of them was essentially a one-off. But the SMR concept is build them on assembly lines and just roll them off and get the scale and learning. So it's an interesting idea, and I'm curious to see if it's going to work too.
Yeah, so you don't have to like custom design a nuclear plant per facility. You can sort of give ones you just plop down at the end of the day, for lack of a better word. Rob, thanks a lot. Really appreciate it. Rob Barnett, Bloomberg Intelligence Energy, Senior Energy and Commodities Analyst, joining us from Florida. Great stuff. A lot more coming up in the next hour of Bloomberg Intelligence.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Norma Linda, because Paul Sweeney is, what do we think he's doing right now?
Having more fun, honestly.
He's
in Ireland. We're having a good time. Don't get me wrong.
You're not having fun right now?
He's a pint.
He does. He has a pint. Or he's hiking. Either one of those things. Paul Sweeney's over in Ireland right now. We are here in our studios in Midtown Manhattan. So far, the gridlock isn't the worst thing I've ever seen, but we'll wait until the midweek when UNGA and Climate Week really... Yeah, wait till you leave. We'll get John Tucker to call in from the traffic world. How about that? Okay, so it's Monday. The markets are open. We're looking for the next catalyst. We have a great hour lined up for you to talk about all of this. Joe Gilbert is Senior Portfolio Manager at Integrity Asset Management. He's going to be joining us in just a moment. Andres Gluski is CEO of AES. It's an energy company. They're the #1 seller of renewable power to corporates. Plus, they own some of the fastest growing utilities in the U.S. So we're going to get their take on really the energy transition, maybe what they made of that Constellation Energy and Microsoft deal to restart a nuclear power plant on 3 Mile Island. Plus, David Doherty is head of oil and renewable fuels research from Bloomberg BNEF. And Lee Klaskow will be joining us, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, on these looming port strikes that could very much disrupt John Tucker's viewing as he sits on the Jersey Shore watching the tankers go by. In the meantime, let's kick it all off with John Tucker for Business Flash. John?
And this Bloomberg Business Flash being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. Stocks at record highs in the S&P 500. 10 of the 11 major industry groups higher right now. Energy leading the way. The stock in the S&P 500. Tesla up over 4% right now. Ulta Beauty, the worst performer, that's down over 3%. Intel, most active. As we've been saying, Apollo Global Management offering to make a multi-billion-dollar investment in Intel. Right now, the S&P 500 up 14 points, up 0.25%, 57.17 on the index. The Dow Jones Industrial Average of 42 points. That's a rise of 0.1%, 42,107. And the NASDAQ 100 right now 59 points higher. That is up 0.3%. Dan Morris over at BNP Asset Management, he says earnings will give stocks a boost going forward.
In general, earnings expectations are positive, and that's true for value, that's true for small cap, it's true for tech. The advantage right now, arguably, is that valuations, at least on a relative basis, are lower for tech than they are for U.S. small tech and value.
We had some of the spot PMIs this morning. That suggests U.S. business activity not growing as quickly as economists had expected. Oh, yes, starting today, you can lease an apartment at the former headquarters for Goldman Sachs, 55 Broad Street. Fascinating article in the Bloomberg today. It only costs you $4,000 a month. So Wall Street...
Is it a studio? Is it what is it?
I don't know. I'll check it out for you. So Wall Street, at this point, I mean, it was years ago. It's just like, come 4:30, 5 o'clock, it was dead. I mean, there was nobody there after hours. Now it's more and more residential. So.
Well, they have a TJ Maxx there now, so therefore everything's okay.
There you go.
Yeah, exactly. All right.
That's how you know.
JT, thanks a lot. John Tucker there on Bloomberg News. All right, let's get more on the markets here. Overall, not really that much happening individually. There's some interesting stocks to focus on. Abigail Doolittle joining us from Bloomberg Television as well. All right, Abigail, what is on your radar?
Well, we're looking at a small gain for the S&P 500 after 2 big up gains, so not a lot happening there. Commodities, your space, really outperforming. The last time I looked at Bloomberg Commodity Index, I'm trying to find it on this sea of symbols here on my terminal, up more than 1%. Wide gains there, natural gas, oil, along
gold
with the wheat.
again.
Yes, gold
to hit
again.
a record.
Although it's interesting that silver is going in the other direction, not down as much as it had been before. But, you know, really beneath the surface of the S&P 500, lots of interesting stories. One of them, of course, being Intel with that Apollo Global Management story, the idea that they are willing to invest up to $5 billion into Intel, and Intel said to be really considering it sharply. This follows last week a soft takeover from Qualcomm. So this chip maker, the old iconic chip maker, which